Priyanka, I saw that.
When I took Priyanka.
Oops.
A very good evening, sir.
Good evening, sir.
Good evening.
Good evening, sir.
Good evening, sir.
Good evening, friends. Good evening, everyone.
Very good evening, sir.
Good evening, sir.
Good evening, sir.
Good evening, sir.
Yes, good evening, everyone there. Shall we start?
Yes, sir.
Yes.
Sir.
Yes. So I think it's the third or fourth session, right? Advanced accounting, the last session. Everyone have the energy?
Yes, sir.
Yes,
Sir.
sir.
Yes. Are we sleeping? I saw Priyanka already sleeping.
No, sir.
No? Okay, we'll start. Now, in this session, again, what are we focusing on? Am I audible properly?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, sir. Sir.
So we are focusing on those chapters that we have discussed already in detail during the regular classes, right? So which are those topics or concepts which are very, very important from the examination point of view? How do we approach that? That would be our focus. Okay, so we'll look into some of the questions as well from the previous exam or RTPs, right? And obviously some important questions otherwise. Right, we'll start with the first chapter. First chapter, I'll start with partnership firms, dissolution. Okay, we'll start with dissolution. Now, in case of dissolution of partnership, we have two concepts there to start with: the dissolution of partnership firm. Correct? Dissolution of partnership firm will compulsorily lead to dissolution of partnership, but it need not be the otherwise. Correct? Change in the terms of the deed will lead to dissolution of partnership, but that might not lead to dissolution of partnership firm. The firm might continue. Whereas dissolution of firm leads to cessation of business activities and it compulsorily leads to dissolution of partnership. In case of dissolution of partnership, what are we focused on? We are focused on closure of books of account. We have to close the books of accounts of the firm. So it is simple. What do we do? How do we close? We will transfer all the assets and liabilities at book value to
Realization.
realization account. We will transfer it to realization account. Assets on the debit side, liabilities on the credit side of the realization account at book value. Then we will record the realizations. Realization of asset, realization of payment of liability, payment of expenses towards realization. That gives us the profit or loss upon realization. Such a profit or loss shall be transferred to partners' capital account in what ratio?
Yes, sir.
Profit sharing ratio. Yes. That would be transferred to partners' capital account in their profit sharing ratio. Then realization account is done. All assets and liabilities are closed. We would prepare partners' capital account. Partners' capital account, we will have opening balance. Correct. To that realization profit or loss shall be transferred. If there are any reserves, that gets transferred into partners' capital account. So and if there are any assets or liabilities taken over by the partners, that also gets transferred to partners' capital account. With this, that gives us the amount payable to or receivable from the partner. Correct. With this, partners' capital account gets closed. We would pay or receive and close the partners' capital account. That leads to only one account left, which is not transferred to realization account. That is cash or bank account. So in cash or bank account, again, opening balance, what all we have received, we would have received realization from assets. And if any amount is received from partners. Correct. That would be recorded on the receipt side. Credit side, payment towards liabilities, expenses upon realization, and if we have paid partners, payment towards partners. That should automatically close the bank account. Correct. This is how normally we will prepare the realization, prepare the dissolution of partnership firm. Now, in some cases, some special cases that we have discussed, there could be dissolution of, rather insolvency of one partner. If there is insolvency of one partner, that partner cannot bring in funds. So in such cases, what do we do? In case of insolvency of one partner, we shall follow
Garner versus Marrero.
wrong. We should first go with the deed. Right? We should first go with the deed. Only if the deed is silent, Garner versus Marrero. Only when the deed is silent, Garner versus Marrero. Now, what does Garner versus Marrero say? It talks about the principles to be followed. First one, realization loss. What with respect to that, what should we do?
Solvent partner should bring in
Solvent partners should bring in their share of realization loss in cash, correct? And second one, insolvent partners' loss shall be borne by solvent partners in their capital ratio, correct? No, insolvent partners' loss shall be borne by solvent partners having credit balance in their capital account only. Right? We have to focus on these points. These are simple points, but it definitely impacts in the examination. So two important conditions that we have to keep in mind. Am I audible properly?
Yes, sir.
Yes, sir.
Yes, sir.
Realization loss shall be borne by solvent partners. Their share of realization loss shall be brought in by the solvent partners in cash. Second, insolvent partners' loss shall be borne by the solvent partners having credit balance in their capital account in their capital ratio. So we have to be complete with respect to all the conditions. Is that clear?
Yes.
Apart from that, whatever we have discussed, realization account, partner's capital account, bank account, same. Right? In case of insolvency of one partner. Same way, in case of insolvency of all partners. In case of insolvency of all partners, we still prepare realization account, partner's capital account, bank account. But in realization account, we will bring in only liabilities. Correct?
Only assets.
We'll bring in only assets. In realization account, we'll bring in only assets. Liability will be transferred to
Deficiency.
deficiency account. No,
Creditors.
total creditors account. Liabilities will be transferred to total creditors account. Now, in realization account, we have brought in only assets. What do? We realize the assets. Correct? Pay the realization expenses. That gives us realization profit or loss. It would be transferred to partner's capital account. In partner's capital account, what do? We have the opening balance. We have the realization profit or loss. We have any reserves or asset taken over, etc. That gives us the amount payable or receivable from the partners. If the amount is payable to the partner, we cannot pay. Amount receivable from the partner will not pay. Because all partners are insolvent. So, any balance in partner's capital account, what do? Transfer it to deficiency account. Very good. Transfer it to deficiency account. Now we have that total creditors account that we had opened to transfer all the liabilities. There, we would pay off the creditors to the extent of cash balance available. What is the cash balance available? Opening balance plus asset realized minus realization expenses paid. That's the cash balance available. We would pay all the liabilities to the extent of cash balance available. That leaves us some amount in this total creditors account. That would be transferred to deficiency account. This makes the deficiency account to tally. Right? Parallelly, we should also prepare bank account, wherein opening balance, realization of assets, payment of realization expenses, and balance amount we would pay the creditors. This is how we go with insolvency of all partners. Correct? Yes, the last part. Now, in all these discussions, we are assuming that we are realizing the assets at once. But that would not be the case practically. We would realize them in installments. In such cases, we have two options. Either to wait till all the assets are realized and then go with the payment of liabilities, or as and when you realize the assets, pay off the liabilities in that order. So if we go with the second option, we have two methods. Maximum possible loss method, highest relative capital method. Correct? Maximum possible loss method, it says that whatever installment that you're receiving, if it's the first installment, that would be considered as the last installment. Correct? That would be, and moreover, maximum possible loss method and highest relative capital method, both are the methods given to calculate the amount or the way in which we would apportion the amounts available among the partners only. We have to first pay off the creditors, external liabilities, we have to first pay off. After paying off the external liabilities, the amount available would be shared among the partners. How do we share among the partners? These two methods will guide us. First, maximum possible loss method. It says further there is nothing receivable. So total capital that we have to pay the partners minus whatever we have received now, that gives us the maximum possible loss. That's the maximum possible loss. So that has to be borne among the partners in their
Profit sharing ratio.
Loss, correct? Profit sharing ratio, that gives us the amount or the way in which we have to share. If in case we get negative in any of the partners, that have to be borne by the other partners in their profit sharing ratio again. So we have to do this exercise till we get positive figures, correct? That is the way in which we would apportion the amounts, correct? Visualizing the problems that we have solved, right? So this is for one installment. Same way we would do for the number of installments that they have given. That is maximum possible loss method. Same way, highest relative capital method. Here we are going with, we are presuming that capital balance should match with profit sharing ratio. If it is not matching with profit sharing ratio, whoever has brought in extra capital than their profit sharing ratio, we have to pay them first. Highest relative capital. So calculate highest relative capital. How do we calculate highest relative capital? We have capital balances, correct? From that, what should we do? We have to divide the capital balances in the respective profit sharing ratio. Remember, we have to divide it with the respective profit sharing ratio. That gives us the quotient. Among that, select the
Least.
very good. Select the least quotient. That would be called the base capital. From that, multiply that base capital with the respective profit sharing ratio. If the profit sharing base capital is 10,000, profit sharing ratio is 5:3:2, 50,000, 30,000, 20,000 would be the hypothetical capital. That hypothetical capital would be reduced from the actual capital balance that we have. That gives us the partner having the highest relative capital. Now there are chances that we get the amounts for two partners. Among them, who has the highest relative capital? Again, we have to find out how. By taking those two partners' profit sharing ratio. That is, if we get B and C, then 3:2 is the profit sharing ratio. So divide them. Again, find out the least, lower among them. Multiply, get the hypothetical capital. You would get the one single partner who has the highest relative capital. Pay off that first. Pay off that first. So that you will get two partners in having the same proportional capital, pay off them so that all three partners have their capital in the profit sharing ratio. From there on, in
Sir,
Your videos.
Now it's fine.
Now it's
Now it's fine.
I was not audible.
Yes, you weren't audible for
Now we
30
are.
seconds. 10 seconds.
Okay, till when you understood or you heard?
Last 10 seconds.
What? I didn't get it.
sir, till it will be the capitals will be in the profit sharing ratio.
Okay, fine, no problem. I'll explain that method again. Highest relative capital method, correct? We started with highest relative capital method. In highest relative capital method, we are going with the presumption that, or we are going with the principle that the partner's capital would be there in their partner's profit sharing ratio itself. So that is the ideal objective. So we have to make the partner's capital to become proportional to their profit sharing ratio. How do we do that? By finding out highest relative capital of the partners. How do we do that? Partners capital divided by their profit sharing ratio respective. That gives us base capitals. Among them, identify the least base capital, multiply with their respective profit sharing ratios would give us the hypothetical capital. Actual minus hypothetical would give us those partners having higher relative capitals. If we have more than one, if we have only one, then it's easy. You have to pay him first. If we have more than one, then what do we do? We have among those two, who has the higher relative capital, find out how. Same, get the profit sharing ratios, respective profit sharing ratios, divide base capital, multiply the base capital into their respective profit sharing ratios, you will get hypothetical capital. Their highest relative capital minus hypothetical capital would give us one single partner having the highest relative capital. Yes. So this, for that partner having the highest relative capital should be paid first. Understood?
Yes.
Yes.
Yes, sir.
Yeah. So this is the basic concepts that are there in this particular chapter. Write down dissolution of partnership firm. Dissolution of partnership firm. Below that, normal dissolution. First one, normal dissolution. Normal dissolution. Below that, close the books of the firm. Close the books of the firm. How do we close the books of the firm? First, we would prepare realization account. So, realization account to assets at book value by liabilities at book value. To assets at book value by liabilities at book value. Then we would realize. So by bank account, realization of assets to bank account, payment of liabilities to bank account,
Payment of its
yeah, realization expenses paid. Then if there is any partner's loan, it's already included in liabilities, you can pay that as well. Then that's it.
Asset taken over. Assets.
Capital accounts.
Asset taken over, will it come to realization account?
Capital account.
Yes, it will directly go to capital account, right? Correct?
Yes.
It will not come to realization account at all. Asset taken over by the partner. So we would calculate the profit or loss. Realization profit or loss, which would be transferred to partner's capital account. Partner's capital account, realization profit or loss in their PSR. That could be profit or loss, right? It could be on the either side depending upon the realization. Okay. This is realization account. Same way we would calculate or rather prepare partner's capital account. Partner's capital account will have opening balance by balance brought down, then realization account. Again, depending on profit or loss, it will come on credit side or debit side, as the case may be. Then if you have any reserves, correct? If profit and loss debit balance, it will go on the debit side of the current account, or rather capital account. Then asset taken over, debit or credit?
Debit.
Good. Asset taken over, debit. So to that particular asset, respective asset taken over. Same way, liabilities taken over would have been credited. That gives us the amount payable or receivable from the partner. So if it's payable to bank account, if it is receivable by bank account. Then last, bank account. Bank account, you will bring in the opening balance to balance brought down to realization account. This represents the assets realized. Same way if we have received any amount from partners. So partners capital account. By realization account, liabilities paid. By realization account, expenses paid. By partners capital account, if you have paid towards any of the partners. This should tally the bank account. Correct? Completed? Yes. Yes, Harshita, you had some doubts?
Yes, sir. Sir, so in the realization account, we won't show partners capital account at all with respect to assets taken over.
No. See, if machinery is taken over, that machinery would not be part of my realization account at all. It would directly go to partners capital.
Yes, sir.
So on my asset side of the realization account also, machinery is not there. So liability side, or rather the debit side of the realization account also, machinery is not there. Credit side of the realization account also, nothing would be there.
Okay, sir. Thanks.
Yes, Rutvik.
Sir, when any asset is taken over or liability is assumed in some agreed value, how will the changes in the book value and the agreed value be accounted?
Okay. So if they have taken over the assets or liabilities at that some
agreed value.
Okay, if it is taken at agreed value, at that point, that differential amount you're talking about. Yeah.
Yes,
okay.
sir.
Differential amount, yes, it could be part of the realization account. So at that time, you might have to bring in, right? You might have to show it. Okay, fine.
Yes.
Make a change there. So assets should be there. Here, partners capital account, asset taken over, correct?
Yes, sir.
Yes, sir.
Asset taken over at agreed value. Same way, liabilities taken over, if any. Yes, you're right. So in this case, it is realization account here. Realization account being asset taken over. To realization account, asset taken over. Clear? Everyone understood?
Yes, sir.
Yes. Okay. So simple. We are in realization account. We are bringing in all assets and all liabilities. Asset realized, we are showing on the credit side of realization account. Asset taken over also, we have to show it on the credit side as partners capital account. Liabilities taken over on the debit side, partners capital account. When you are bringing the assets and liabilities at book value, when the assets and liabilities are taken over, it will be at taken over by the partner. It will be at
Agreed value.
Agreed value.
very good. It will be at agreed value. If you want, you can write. Did I write? No. Asset taken over at agreed value. asset taken over at agreed value. Okay, this is normal dissolution. Next line, second arrow mark, dissolution of the firm because of insolvency of one partner. Dissolution of the firm because of insolvency of one partner. Below that, two arrow marks. Two arrow marks. First, go with the deed. Go with the deed, partnership deed. Second arrow mark, if deed is silent, then Garner versus Marer. Garner versus Marer principle. Below that, what does that principle talk about? 2 points. Point number 1, solvent partners to bring in their share of realization loss. Solvent partners to bring in their share of realization loss in cash. To bring in their share of realization loss in cash. Second, loss of insolvent partners to be borne by solvent partners. Loss of insolvent partners to be borne by solvent partners having credit balance of capital. Having credit balance of capital in their capital ratio. In their capital ratio. Yes. Below that, completely below that, capital ratio, to consider the capital ratio, which is the capital balance that we consider? After
Credit
adjusting
balances.
collection reserves, etc., or before opening balance? Before. So for capital ratio, consider the opening capital balance. Next point. For capital ratio, consider opening capital balance. Next point. Subject to the above, accounts shall be closed as per normal dissolution. Accounts will be closed as per normal dissolution.
Sir,
That is preparing
Sir, your voice is-
realization account, partners capital account, and bank account. Third, yes, was I not
So your
audible?
voice is breaking.
Yes.
Is it fine now?
It was lagging.
You're stuck, sir.
lagging, sir.
Okay. Am I audible now?
So your voice is
breaking, sir.
breaking.
It's still breaking, sir.
Still breaking.
Now? Am I audible?
Breaking,
So
sir.
it's breaking.
Breaking, sir.
Just a second. Am I audible now?
Yes, sir.
Am I visible now?
Yes.
Yes.
Okay, right. We'll continue. Okay, did we write the point completely?
Sir, we wrote
Regarding-
till as per normal dissolution.
Yeah, so subject to the above points, the books would be closed as per the normal dissolution, correct? What is normal dissolution? Same three accounts: realization account, partners capital account, cashier bank account. Understood till here?
Yes, sir.
Yes, sir.
Yes. Roman number 3. Insolvency of all partners.
All partners.
Insolvency of all partners. Below that, all assets shall be taken to realization account. Within brackets, only assets. Only assets. Next, all liabilities am I audible?
Yes, sir.
Yes, sir.
Yes, sir.
Sir.
Is all liabilities within brackets including partner's spouse loan, not partner's loan, partner's spouse loan, including partner's spouse loan to be transferred to total creditors account. To be transferred to total creditors account. Point number 3, partner's loan. What do we do with partner's loan? In case of
Adjusted
insolvency of all
against
partners.
capital.
Very good. Partner's loan account to be transferred to partner's capital account. So it will be adjusted against partner's capital. Partner's loan account to be transferred to partner's capital account. Rather, it will be added to partner's capital, partner's loan. Then below that, use the cash available after realization of assets. Use the cash available after realization of assets to pay the creditors. And the balance in such creditors account. To be transferred to deficiency account. Then next point, prepare partner's capital account. Any balance in partner's capital account. Again, I'm not giving how to prepare partner's capital because we've already discussed in Roman numeral 1, normal dissolution, correct? So prepare partner's capital account. Any balance in partner's capital account shall be transferred to, again, deficiency account. Clear with this? Yes. Next line, the bank account will automatically get tallied. Bank account will automatically get tallied. Next, last arrow, fourth numeral, Roman numeral 4. Last one, piecemeal distribution. Below that, first pay off all the creditors, external liabilities. First pay off all the external liabilities. Then the partners then the payment towards partners capital. Then the payment towards partners capital shall be as follows. Payment towards partners capital shall be as follows. 2 hour marks. First one. What is the first method?
Maximum
Maximum loss possible method. That is what I heard. Maximum possible loss method. Maximum possible loss method and highest relative capital method. Maximum possible loss method. Under that, every realization of asset shall be considered as
first installment.
Shall be considered as last installment. No further receivable. Last installment shall be considered as last installment within brackets. That is no further realization. No further realization. And close the brackets and continue. And accordingly, loss will be calculated. Accordingly, loss will be calculated. Such loss to be apportioned. Such loss to be apportioned in their
Yes.
profit sharing ratio. Such loss to be apportioned in their profit sharing ratio. This loss shall be reduced from the capital. This loss to be reduced from the capital, which gives us the basis of apportionment of payment. Which gives us the basis of apportionment of payment. Last point. This exercise shall be made. This exercise shall be made for all installments. It shall be made for all installments. Below that, example, ABC partners, capital of, you can if you want, you can write it completely below that also, if you find it difficult to fit in there. So you can give the heading. This is maximum possible loss method. So capital balances 50,000, 30,000, 20,000. Installment that we have received, first installment. Let's say total profit sharing ratio is 3:2:1. First installment that we are receiving, let's say 20,000. If it is 20,000, total capital is how much?
1 lakh.
1 lakh. What is the maximum possible loss?
80,000.
The maximum possible loss is 80,000. That would be apportioned in PSR. So
Yes.
apportion 80,000 in 3:2:1. First one is 40,000. Then Do we get 26,666?
26,666.
26,667.
13,333.
333.
Right? So if you subtract, you get 10,000, you get 3,333, you get 6,667. This is how, if you add up, this is 20,000. Correct? This is how this installment of 20,000 shall be apportioned. Everyone understood?
Yes, sir.
Yes. Next, come back to the arrow mark. We have highest relative capital method. Highest relative capital method. Under that, partner having highest relative capital. What does that mean? Highest relative capital in terms of profit sharing ratio. Highest relative capital in terms of profit sharing ratio shall be paid first. How do we pay them first? How do we calculate who has the highest relative capital? Divide the capital balances. Divide capital balances in their respective
Profit sharing ratio.
Yeah, in their respective PSRs. Respective PSRs. This gives us base capital. No. No. Least among them is considered as base capital. Least among the quotient. Least among the quotient shall be considered as base capital. Next, what is the next step? Base capital into
Respective PSR.
yes, base capital into respective PSR will give us hypothetical capital. Subtract hypothetical capital from actual capital. Hypothetical capital from actual capital, which gives us actual capital, that gives us the capital highest relative capitals, which gives us the highest relative capitals, Below that, continue this until getting one partner having highest relative capital. Continue this until getting one partner having highest relative capital, so that he will be paid first. Clear?
Yes.
Yes. Example 2. Example 2. Again, we'll take the same one. Capital 50,000, 30,000, 20,000, 20,000. 3:2:1 is the profit sharing ratio. Okay. Now, what do we do first? We have to find out highest relative capital. So we'll divide 3, 2, and 1. If I divide 50,000 by 3,
$16,600.
16,667. Then 15,000 and last one
20,000.
20,000. Last one 20,000. Now, which is the capital that we'll consider as base? Which is the amount?
15,000.
15,000 is considered as base capital. Multiply 15,000 into 3, 45,000. 15,000 into 2, 30,000. 15,000 into 1, 15,000. This is what hypothetical capitals. Hypothetical capitals. Now subtract actual from hypothetical. Hypothetical from actual. 50,000 minus 45 is 5. 30 minus 30 is 0. 20 minus 15 is 5. So we have 2. We have to reduce this 2 to 1. What do we do? Again, same exercise. Now, what is the ratios that I take? 3 and 1. Correct. 50,000 divided by 3, you get 1667. 5,000 divided by 1 is 5,000. $5,000 divided by 1 is 5,000. Okay. Now, out of this, base capital is
1667.
1667. 1667 into 3 is 5,000. 1667 into 1 is 1667. Divide. This is the actual capital. This is the hypothetical capital. 5,000 minus 5,000, 0. 5,000 minus 1667, 3333. Below that, we will pay partner C. We will pay partner C first to the extent of rupees 3333. To the extent of rupees 3333. Correct? Yes. Everyone understood? Now,
Yes,
if
sir.
we had 20,000 in the first installment, how do we apportion among the partners? First, you will
pay 3,333.
partner C pay 3,333. Then what happens? Then the capitals of C will be in the same proportion as their profit sharing ratio. Correct? So if I pay 3,333, this becomes 1,667. Correct? Since this is 5,000, I'll pay 3,333. This becomes 1,667. Now, can I say A and C have higher relative capital than B to the extent of 5,000 and 1,667? Everyone understanding?
Yes, sir.
Yes.
Okay. So to the extent of 5,000 and 1,667, A and C have higher relative capitals than B. So pay off A and C. Pay off A and C. How much? 6,667. 5,000 and 1,667. That comes up to 10,000. You have 10 more thousand left. Now, if you look into, you have paid A, how much? 5,000. His balance is 45,000. You have paid B, nothing. His balance is 30,000. You have paid C, 3,333 and 1,667, which is 5,000. 20,000 minus 5,000 is 15,000. So if you look into 45, 30, 15, same as hypothetical capital, that means it is in the ratio of 3:2:1. So balance 10,000 would be paid in the ratio of 3:2:1. That is, A would be paid 5,000, B would be paid 3,333, and C would be paid 1,667. So if we have 20,000, this is how it shall be paid. If you want to summarize, A is paid 5,000, No, 5,000 and 1667. 6667. Correct? No. A is paid only 5,000 plus 5,000. Sorry, 10,000. A is paid 10,000. B is paid 3333. C is paid 5,000 and 1667. 6,667. Thereby, we have 20,000. Clear? Everyone understood?
Yes, sir.
Yes, sir.
Yeah. So this is how it can be asked, the maximum adjustment possible, all in one single adjustment, or rather one single installment. We had multiple adjustments that we have discussed in single example. Okay. So with this, we are done with dissolution of any doubts in this. I've gone in detail because it's very important. The chapter is very important. Any doubts in this? No. Okay. As a part of this chapter, we also have something called LLP. Right? Sometimes questions can be asked. 5 marker, easy. We can easily score 5 marks. So we should not lose that. So what all we have to look into? We have to look into, basically, we have to focus on differences between LLP and partnership firm. Right? Which is the act that is applicable for partnership firms?
Limited Liability Partnership Act 2008.
Indian Partnership Act 2032.
1932.
Partnership Act 1932. Whereas for LLPs?
2008.
2008 LLP Act.
2008. Enter partnership registration is compulsory or optional?
Optional.
Optional. Whereas for LLPs?
Compulsory.
R2C.
Partnership firms are not body corporates, whereas LLP are body corporates. Partnership firm does not have separate legal entity, whereas LLP has separate legal entities. And the partnership firm does not have perpetual succession, whereas LLP has perpetual succession. In case of partnership firm, minimum partner 2, LLP also minimum partner 2. Partnership firm, maximum partner 50 or 100?
50.
50. In case of LLP?
No.
No limit. No limit for maximum partners. Correct. And liability of partnership. In case of liability of partnership.
Unlimited.
Unlimited. For LLP, it is limited except in case of fraud. Very good. Except in case of fraud. And in case of partnership firms, partners are agents of the firm as well as other partners. But in case of LLP, partners are agents of the firm only. Correct? Right? This is the major differences that we have to keep in mind. Apart from that, they can ask you about in which situations LLP can be wound up by tribunal. Right? We have discussed various situations where it can be wound up by tribunal. So those things can be asked. Okay? We have to look into that particular theory part. Clear? Can we look into some of the questions in this resolution?
Yes.
Yeah. First, I'll go to our previous exam, November 22 exam. In November 22, it was asked for, from this chapter, it was asked for 20 marks. It was asked for 20 marks, 15 marks of dissolution of partnership, 5 marks of LLP. Okay, dissolution of partnership. Look at this. MN and over in partnership sharing profits and losses 3:2:1. No provision in the agreement for interest on capital or drawings. M died on 31st of March 2021. On that date, partners' balances were as under capital M, N and O, current account M, N and O. By partnership agreement, the sum due to M's estate was required to be paid within a period of 3 years. And minimum installment of 37,500 each were to be paid. First such installment falling due immediately after death and subsequent installments at half-year intervals. Interest at 6% were to be credited half-yearly. In ascertaining M's share, goodwill not recorded in the books was to be valued at 1,12,500 and the assets, excluding joint assurance policy mentioned below, were valued at 75,000 in excess of the book value. What does this mean? Revaluation profit. Correct. Upon death of the partner. No goodwill account was raised and no alteration was made in the book values of fixed asset. Joint assurance policy shown in the books are at 50,000 matured on 1/4/2021, realizing 65,000. Payment of 37,500 each were made to M's executors on 1/4/21, 39/21, 31/3/21. N and O continued trading on the same terms as previously, and net profit for the year ending 31st March 22 before charging interest due to M's estate amounted to 65,000. During that period, partners' drawings were 18,750 and 10,000. On 1/4/2022, partnership was dissolved and an offer to purchase the business as a going concern for 2,25,000 was accepted on that date. Check for that sum was received on 30th of June 2022. Balance dues due to M's estate, including interest, was paid on 30/6/2022, and on that day, N and O received the sums due to them. What should we do? Prepare partners, capital account partners, current account from 1/4/2021 to 30/6/2022. Also show executors of M's account. Executors of M. Exactly the same problem that we have solved in the class. Correct? It's exactly the same problem. What are we supposed to do? Go. Yes, we have to prepare all the three accounts, no doubt about it. Go in a chronological order. First, finish off death of the partner related discussion. Then finish, completely close the executor's account. Then again come back that financial year. See, when did the partner die? 31st March 21. So April 21 to March 22 financial year, they have run the business. Correct. For that financial year, they have given us the profit, but before charging interest. So accordingly, charge interest, you will get the net profit, apportion that net profit. They have given us the partner's drawings. Correct. So accordingly, we can ascertain the closing balances as on 31st March 22. Now, on 1st of April, it was dissolved, but amount was received only on 30th of June. Estate would be paid only on 30th of June. So first, then close current account, transfer the balance to capital account, and accordingly close the capital account. That is what we would have done in the class. If you look into the answer, if you require it, again, we have solved this already. Right? I'll just go to adjustment regarding goodwill. Since goodwill is not to be recorded in the books, what will we do? Share of goodwill before death in old profit sharing ratio, share of goodwill after death in the new profit sharing ratio. So find out the difference. M should be credited by 56,250, N 37,500 minus 75,000, 37,500 debit, O 18,750 debit. That means 56,250 of M would be borne by N and O in this ratio. Accordingly, we have to pass. What is the entry that we will pass? N's capital account debit 37,500, O's capital account debit 18,750, or capital or current account. Since this is current here, current account. To M's current account 56,250. Everyone understanding? Adjustment regarding goodwill.
Yes, sir.
Same way. Adjustment regarding revaluation of asset. What have they said? 75,000. Correct. Now they are not selling the asset; they are just revaluing. That's out of that 75,000, 3:2:1 is the ratio of M. So 37,000 is the 37,500 is the profit of M, which you have to give him. Who will bear that? N and O, because they are the persons who are enjoying the assets in future. So N and O would have to bear it in what ratio? 2:1. So 25,000 and 12,500. Clear? 37,500, 25,000, 12,500. That is how they will bear. Same again. N's current account, O's current account to M's current account. That is the entry that we will pass. Then for financial year 22, financial year ending 22, how do you get the profit? 65,000 net profit they have given. Calculate interest chargeable on M's executors. They have said half yearly interest should be charged. So for first half year, what is the interest? Second half year, what is the interest? How do you get it? Through M's executors account. By preparing M's executors account, you will get the interest. Thereby, profit is given, share them in the ratio of 2:1. Is that clear?
Yes, sir.
Yes.
Yes, sir.
Okay, one more important point here that we have to focus on. Here, what have they given? What is the interest rate given? Interest at 6% be credited half yearly. They have not given per annum. So you have to go with 6% for half yearly or 6% per annum calculated half yearly. Which is the right calculation? First one, that is 6 months, 6% every half year. Right? Now, Going with the literal understanding, yes, since they have not given per annum, interest at 6% was to be credited half yearly. You can calculate 6% interest every half year. If the loan amount was, the amount to be paid was 1 lakh, first half year it would be 6,000 interest. Second half year it would be 1,06,000 into 6% interest. So every half year you can calculate 6% if there is no per annum. But whatever you are doing, given out the way they have given here. What is the note that they have given here? As per the information given in the question, interest at 6% was to be credited half yearly to AIMS executor's account. Hence, rate of 12% per annum has been considered in the solution while working the interest computation. So they have considered 12% per annum, that is 6% every half year. Is that clear?
Yes, sir.
The second part of this question, part B, differentiate on ordinary partnership firm with an LLP in the respect of following. So applicable law, we already discussed Partnership Act, LLP Act. Perpetual succession, not available, available. Ownership of assets, we didn't discuss. In partnership firm, ownership of assets with the partners. LLP, ownership of assets with the LLP. Correct. Then liability of the partners or members, we have discussed. Unlimited and limited. Principal agent relationship also we have discussed. Agent of the firm as well as other partners, agent of firm only. Right. This was asked for 20 marks in the last exam. Now, can we also look into the current RTP? What have they given? May 23 RTP. PQ
Yes,
and R are sharing profits and losses in the ratio of 5:3:2. Due to finding of frauds committed by R during the year, it was decided to dissolve the partnership on 31st March 22. As on 31st March 22, their partnership is given. Their balance sheet is given. Additional information are given as under. During the year, R sold investment costing 45,000 at 56,000 and said funds were transferred to his personal account. This transaction was not recorded in the firm's book. Point number 1. A check for 30,000 was received from the debtor, not recorded in the books and was misappropriated by R. Trade creditor agreed to take over the stock of book value 25,000 at 26,500. Rest of the trade creditors were paid off at a discount of 2%. The bills payable were settled at 2% discount. Expense of dissolution 5,900. Other assets realized were plant and machinery 5% above the book value. Stock, rest of the stock realized at 15,000. Why they have given rest of the stock?
Stock have been taken over by credit.
Very good. Stock is taken over by the creditor. Investment, rest of the investments were sold because balance investment was already sold by one of the partners. Debtors, rest of the debtors were realized because one of the debtor has paid, but which was misappropriated. Q agreed to take over the loan of Mrs. Q of 1,75,000. Realizable value of R's private assets would be only 20,000. Applying the principles laid down in Garner versus Murray, prepare realization cash account and partners capital account. First, what you have to do? First, prepare realization account, normal realization account. When you are preparing realization account, you have to be careful. Now, investments, even though here we have investment 1,45,000, I cannot bring in 1,45,000 in realization account because 45,000 is already sold by one of. Correct? Yes. So only 1 lakh would be brought in. What happens to this 45,000? I'll explain. Next, you have debtors. Even though debtors has 2,10,000, I cannot bring in 2,10,000 because 30,000 was already received. So only 1,80,000 is receivable. Then you have trade creditors. Trade creditors anyhow, full we are paying. One is liability taken over, right? Liability taken over. So that anyhow, it's not a problem. Bills payable, not a problem. Expense of dissolution, not a problem. These assets are also not a problem. We are bringing all other assets, correct? Q's loan, 1,75,000, it is being taken over by Q. Again, you can bring it in realization account and transfer it to Q's capital account. Now, using this, if you prepare the realization account, you'll get the realization profit or loss transfer to partners capital. In partners capital, first you have to adjust for all this misappropriation which R has done. Now, what should have been the entry for sale of investment? Bank account debit to investment account to Profit, I think this is, yeah, 11,000. Profit on sale of investment, correct? This should have been the entry, but no entry was passed. Now I have to receive 56,000 from the partner, correct? So we have to recognize that 56,000. How do we recognize that? Bank account 45, not bank account, investment account 45,000, P&L account 11,000 into the partner's capital. Same way, 30,000 we have to receive from one of the debtors. So this is capital account, R's capital account debit to debtors account, right? So accordingly, we would have closed that. So once we do this, then normal, we would bring in, solvent partners would bring in their share of cash, their share of realization loss in cash. Then you bring R's money of 20,000. R can bring in 20,000. With that, that gives you the loss of partner R. That would be borne by the solvent partners in their capital if they have credit balances. If both the partners have credit balances, that would be borne by both, else only. But is that clear?
Yes, sir.
Everyone understanding?
Yes, sir.
Yes, sir.
Yes, sir.
Yes. Okay. See again, 1B, LLP related. Under what circumstances LLP can be wound up by the tribunal? Right? It's a theory question. We can refer to that. But don't miss that. Easily we can score 5 marks in that. So please don't miss it. Okay, fine. So we have one more question left. We'll quickly look into it. This is again theory part which we have already discussed. So I'll directly go back to question 172 page number. You have this particular question. This is about highest relative capital method that we solve, right? Highest relative capital method. How do we solve this? Highest relative capital method, or what is the question talking about? They have given us the assets. What are the liabilities that we have? Only creditors of 16,000, correct? Creditors of 16,000. Now, how are we receiving this? Partner share in the profit and loss, cash is distributed at end of each month. This is for January. For January, collected from debtors 9,000, received from sale of furniture 8,000, liquidation expense 1,000. 9 plus 8, 17. 17 minus 16. Cash
Minus 6.
10,000. Correct. Now, how do we pay this first? We have to pay the creditors first. Creditors is 16,000, but we also have opening balance of cash 9,000. So that also have to be considered. We have 10,000 here plus 19,000. First pay off 16,000 to the creditors. You have 3,000 left. How do we apportion? You have to calculate highest relative capital. How to calculate highest relative capital? With example we have discussed just now. Should I discuss that again? No, right? So based on that, you would apportion. So if you will directly go to the answer, see 52,000, 43,000 and 32,000. Using that, how did they calculate highest relative capital? 65,000. How did this become 52,000? Because you have partner's loan here. Partner's loan gets adjusted. Correct? 65 became 52. 65 minus 13. 32 minus 7 is 25. So 52 and 32. That is how we get it. Then 65,000, 50,500 and 32. Partner's loan that made 52, 43,500 and 32. Their property generation 4:3:2. 52 by 4 is 13. 43,500 by 3 is 14,500. 32,000 by 2 is 16,000. Multiply. Which is the lowest one? 13. 13 into 4, 52. 13 into 3, 39. 13 into 2, 26. So 52,000 minus 52,000, 0. 43,500 minus 39,000, 4,500. 32,000 minus 26,000, 6,000. Now we have these two. 3:2 is the ratio. Divide. 4,500 by 3 is 1,500. 6,000 by 2 is 3,000. 1,500 into 3, 4,500. 1,500 into 2, 3,000. 4,500 minus 4,500, 0. 6,000 minus 3,000, 3,000. Correct? So, R's highest relative capital is 3,000. Coincidentally, amount remaining is also 3,000. Pay that entire 3,000 here. Once we pay that, this is the amounts available. Second month, February, we have opening balance of 6,000. We have paid 1,000 rupees reputation expense of 5,000 we have. Correct? as part of payment, part payment of his capital, R accepted machinery for 9,000. Book value was 3,500, taking at 9,000. So we have to reduce that 9,000. We are reducing that 9,000. We have 5,000 cash. Cash retained at the business at the end of the month too. So 5 minus 2, 3,000 available. How do we pay that 3,000? Again, calculate. Now remember, capital balance has changed. How? Anyone?
Plan taken over by R.
Correct. Plant taken over by R. So only Q will have highest relative capital, pay off Q. That is how we will get it. Then the last month, you have 2,000 opening, 38, 40,000, 50,000, minus 1,700, plus 41,000. The entire amount would be paid in the same ratio. That is how highest relative capital method would be followed. Is that clear? Yes, this is the first chapter,
Yes.
dissolution. Can I move on to the next chapter?
Yes.
Yes.
Yes, sir.
Okay. In continuation of the same, we have amalgamation, conversion, and sale of firm. This time it can be important because in the November exam, no question was asked. In November exam, no question was asked. So this time it can be important. 10 marks or 15 marks can be asked. So here we have 3: amalgamation, conversion, sale. Ultimately, in case of amalgamation of firm, what is happening? 2 or more firms get together, merge, right? So their old firms' books have to be closed. How to close, we already know. New firms' books have to be opened, incorporated. Assets would be taken over by the new firm. That would be incorporated in the new firm. So in case of amalgamation of firm, what are we doing here? We are revaluing the assets. So revaluation account will be prepared. Amalgamation of firms, revaluation account would be prepared. Partners capital account would be closed. How do the partners be paid here? How do the partners be paid? Am I audible?
Yes, sir.
Yes, sir.
How do the partners be paid in case of amalgamation? They're not paid in cash. They are given profit sharing ratio in the new firm. Correct? So partners capital would be transferred to the new firm. The closing balance in the partners capital of the old firm. Correct? Same incorporation entries will be passed in the new firm. When you are closing the old firm in revaluation account, all assets and liabilities will be brought in book value. When you are incorporating the entries into the new firm, it would be at actual agreed values, takeover values. Correct? Yes. That is amalgamation of firm. Which is the account that we'll open? Amalgamation? Valuation account. Conversion of firm. Procedure is the same. You would close the books of the firm by closing down all the assets and liabilities. Here, assets and liabilities are not realized. Instead, we are converting it. A company is taking over that. Correct? Converting the firm into company. So assets and liabilities of the firm becomes the assets and liabilities of the company. So we're not selling it. So how do we close the realization account? By issuing shares to the partners. But that is called purchase consideration. Correct? Right? Here, which is the account that we will open? In amalgamation, we open revaluation account. In conversion, we will open reconstruction account because we are reconstituting from firm to company. Reconstruction account. In case of sale of firm, we are selling realization account. We are selling realization account. Apart from these difference, whether it's amalgamation, conversion, or sale, the treatment remains the same. We have to close the assets and liabilities of the old firm, give the partners their stake in the new firm or the new company, whether it is in the form of capital or shares, and bring the balances of old firms into the new firm or new company, as the case may be. So it can be a journal entries that be asked. It could be ledger accounts that can be asked. Okay, clear with this? It's a small chapter, but this time there are chances that it can be asked. Write down amalgamation, conversion, or sale of firms. Amalgamation, conversion, or sale of firms. Below that, 3 arrow marks. 3 arrow marks. First one, amalgamation. First one, amalgamation. Under that, prepare
Evaluation.
revaluation account. Prepare revaluation account. Second arrow mark, conversion. Conversion means what? Conversion of firm into
Company.
company. Conversion, prepare
Reconstruction.
reconstruction account. Very good. Reconstruction account. And third one, sale. Prepare
Realization.
realization account. Prepare realization account. Now, completely below that, apart from the above difference, the accounting treatments shall remain the same. The accounting treatments shall remain the same. That is 2 arrow marks. 2 arrow marks, left hand side. Left hand side in the books of old firm. In the books of old firm, close all the assets and liabilities. Close all the assets and liabilities. Close all the assets and liabilities. Push up. Transfer old partners' capital balances to the new firm. To the new firm, or close partners' capital accounts. Close partners' capital account by allotting shares. By allotting shares. In case of conversion or sale of firm into company, right? We allot shares to the partners. Then, right hand side, in the books of new firm bar company. In the books of new firm bar company, incorporate all assets and liabilities. Incorporate all assets and liabilities at agreed value. In the new company, it is at agreed value, correct? New company or firm, it is at agreed value. This is simple. You visualize amalgamation of companies that you would have learned. Same principle have to be applied. So the only difference is the ledger accounts that we prepare: evaluation account, reconstruction account, and realization account. Is that clear? Yes, that is what is there. Nothing extra. Any doubts? Anyone? No. Okay. We'll go back to the question. Again, as I said, November 22, no question was asked. So I'll directly go to RTP. In RTP, we have one question. We'll see this. Messrs. Happy Makers is a partnership firm consisting of Mr. Happy, Mr. UV, and Mr. Mohan, who share profits and losses in the ratio of 2:1. Global Limited is a company doing similar business. Summarize balance sheet. They've given us a balance sheet of firm as well as company. Happy Makers, Global Limited, equity share capital. This is the share capital of the firm, correct? Yes.
Company.
Yes, it's the share capital of company. Partners capital, they have given general reserves, trade payables, plant and machinery, furniture, inventory, receivable, cash in bank, cash in hand. On the balance sheet data, it was decided that Happy Makers be dissolved and all the assets except cash in hand and cash at bank and all the liabilities of the firm be taken over by Global Limited by issuing 75,000 shares of rupees 10 each at rupees 2 per share. Partners of Messrs. Happy Makers agreed to divide the shares issued by Global Limited in their profit sharing ratio and bring necessary cash for settlement of their capital. Easy. The trade payables of Messrs. Happy Makers include 1,50,000 payable to Global Limited, and unrecorded liability of 37,500 of Happy Makers must also be taken over by Global Limited. Assume that cash at bank has been withdrawn to pay to the partner, Mr. UV. What are we supposed to prepare? Realization account, partners capital account, cash in hand at bank account in books of Happy Makers, journal entry in the books of Global Limited for acquisition of Happy Makers, and draw balance sheet of Global Limited after takeover. Okay, same question can be asked in your exams also for 15 marks or 20 marks, who knows? So we'll look into how they have solved, or how, again, similar question we have solved in the class. Next, I think, yes. Realization account. Bring all the assets, bring all the liabilities, including that common liability. Mutual indebtedness also have to be brought in. Why? Because we have to close the books of the old firm. That mutual indebtedness would be eliminated only in the new company once it is transferred to the new company. Correct? Then Global Limited, how do we calculate the purchase consideration? They have given us the mode of discharge. They have told 75,000 shares at rupees 12 per share, 2 rupees premium. So 75,000 into 12, do we get 9 lakh?
Yes, sir.
Yes, sir.
So
Yes.
that is how they have given it in the form of working note. That is how they have got 9 lakh. Okay. Now, that's all. This gives us the realization loss. Transfer it in partners capital account. Partners capital account, we have the opening balance, we have general reserve, bring it in their profit sharing ratio. Then realization loss. Now, with regard to shares, what have they said? They will apportion the shares in their profit sharing ratio. Correct? And balance, if any, would be brought in cash or taken over by cash. So 9 lakh rupees would be apportioned in their profit sharing ratio in this manner: 3,60,000, 3,60,000, 1,80,000. This gives us the balancing figures. Happy and Mohan will have to bring in, UV will withdraw. That is, company has to pay UV. Understood this adjustment?
Yes.
Everyone?
Yes, sir.
Yes, sir.
Okay. Cash at bank. Now we have balancing figure, balance brought down, opening balance. Then Happy has brought in, Mohan has brought in, UV we paid, cash, we have bank balance, draw that and pay UV. That is what they have told in the question. What did they tell? Cash balance have to be paid. Again, to go back. Yes, I can. Here, assume that cash at bank has been withdrawn to pay. So we have drawn cash. Contra entry has been passed accordingly. Right? Contra entry is passed in cash and bank account. That is how we close the books of old firm. New company. First, we have to record the purchase consideration, right? Business purchase account debit to liquidators of Happy Makers, 9 lakh. Now, because of that, what are we bringing? Plant and machinery, furniture and fixtures, inventory, trade receivables, trade payables. There is one unrecorded liability, 37,500. Unrecorded liability has to be brought in. That is one point that we have to keep in mind. Business purchase account. The resultant credit balance would have been credited to capital reserve. If it was a debit balance,
Goodwill.
goodwill. If it was a debit balance, it would have been to goodwill account. So if it was a normal without any special adjustments, these are the two entries that would have passed. But these are the two entries, and we have to discharge the purchase consideration by allotment of shares. How do we discharge? Liquidators of Happy Makers to equity share capital to securities premium. But here we have mutual indebtedness, trade payables account debit to trade receivable account, that 1,50,000. That's all. These are the entries that we have to pass in new firm, new company. After that, prepare the balance sheet. Share capital, we already know. How did existing share capital plus fresh shares that we have issued. They have existing balance sheet. Reserves and surplus, existing reserves. Here, what we have added? I think we have added only securities premium. Capital reserve. Yes, we have capital reserve also. Correct. Capital reserve. Then trade payables, there will be change. Other liabilities, unrecorded can be brought in as other current liabilities. Property, plant and equipment, there is a change. Inventory, there will be change. Trade receivable, there is a change. Cash and cash equivalent, no change. Will there be a change in cash and cash equivalent? No.
No.
No change. That's all. This is how we will have to look into the conversion of firm into company. Okay, same way, can we look into one more question? Everyone understanding, following?
Yes, sir.
Yes, sir.
May 22, RTP. You and we were in partnership with sharing profits and losses equally. Firm's balance sheet as at 31st December 2021 for 9 months was, they have given us equity and liabilities and assets, partners capital, sundry creditors and bank overdraft, plant, building, data, stock, P&L account, debit balance, partners drawings account. Operations of the business were carried on till 31st of March 2022. You and we both withdrew in equal amount, half amount of profit made during the current period of 3 months after charging depreciation of 5,000 of plant, after writing of 5% of building during the current period of 3 months. Creditors were reduced by 50,000, bank overdraft by 50,000, stock was valued at 24,000, debtors at 40,500 at 31st March 2022. Other items remained the same as at 31st December 2021. On 31st of March 2022, firm sold its business to UV Limited. Value of goodwill was estimated at 1,84,000. Remaining assets were valued on the basis of balance sheet as on 31st March 22, except building and stock, which were valued as follows. UV Limited purchase consideration equity shares of rupees 10 each. You are required to prepare balance sheet, realization account, balance sheet of the firm as on 31st March, realization account, and partners capital account showing file settlement. Now, preparation of balance sheet becomes important because to calculate purchase consideration, you want asset values as on 31st March 2022. Right? Balance sheet is also a requirement, and that helps us in the further solutions. Now, what have they told? They both withdrew equal amount, half the amount of profit made during the current 3-year period. Now, if you remember, one of the problems we had solved, same thing we had. In such cases, how do we get it? We would go with the change in. How do we get the profit? How did we get the
Change
profit?
in capitals.
Change in capitals. Here we do not have the capital balances, so we go with change in assets.
Net
Change in assets, correct? Right? See, during the current period, creditors were reduced by 50,000. Bank overdraft were reduced by 50,000. Stock was valued at 24,000. Debtors at 40,500. Other items were remained the same. So using this, find out the profit. How do we find out the profit? Ascertaining profits. Consider all the present values of assets. Present values of liabilities. This gives you the closing net asset. Take the opening capitals. Closing net assets. Net asset means what? Asset minus external liability, which is nothing but capital. This is the closing capital. This is the opening capital. This represents increase in capital. Correct? Now, can I appropriate the entire increase in capital as profit? The answer is no, because they have withdrawn also drawings. They have said half amount is withdrawn. So that means remaining half is left here. So add same amount, you will get the profits. Profit is 27,000. Profit for the 3 months, 27,000. Everyone understood how did we get the profit?
Yes.
Yes. Why is that required to get the balance sheet done? In the balance sheet, now you have plant 1,85,000. They have given depreciation 5,000, building return of 5,000, stock they have given, debtors they have given, bank overdraft reduced by 50, sundry creditors reduced by 50. Now capital balances. How do we get the capital balances? One, you have the opening balance. You know the profit for the 3 months. You know the drawings for the 3 months. Using that, you get the capital balances. Thereby, balance sheet of the firm is done. Once you are done with the balance sheet of the firm, you have to calculate what? Purchase consideration. What are they telling? Same values as on 31st March 22, except for building and stock. Apart from building and stock, you are taking all values the same. One thing extra, what? Goodwill. Correct? Goodwill is extra. So, ascertainment of purchase consideration, you will take stock, revised value, debtors book value, plant less depreciation book value, building revised value that they have given. Sundry creditors, same, back overdraft, same. To this, you will add goodwill. That gives you the purchase consideration. They have told 10 rupees share, total number of shares, 48,750. Correct? Now, why does purchase consideration required in realization account? Bring all the assets at book value. Do you know the book value? We have prepared the
Yes.
balance sheet just now. Correct? We know the book value. We know the purchase consideration. This gives us the realization profit or loss. Simple. Then they're asking partners capital account. We know here there are two ways. Since we have already done the partners capital account to ascertain the balance sheet, correct, in the working note, you need not bring that. You can directly start with the balance sheet, capital account balances as on 31st March 22, or as given in the balance sheet, opening balance, add profit minus drawings. That gives you the closing balance, and then bring that to the next year. Here you have realization profit. That how does this be settled? By issuing shares. By issuing shares. That's all. This is what the question is all about. Okay. Now, if anyone has any doubts in any of these questions, ask. No doubts? Till here, everyone understood whatever we have discussed?
Yes.
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 Oh, fine then. So with that, we are done with the partnership accounts related discussions. We had dissolution, amalgamation, conversion, and sale. Right? Out of this, 20 marks guaranteed. 20 marks definite. Okay. So please focus on these chapters. Solve some more problems. You will be thorough with it. For concepts, whatever I have given the notes, that is more than sufficient. Based on that, solve some more problems. You'll be fine with this. Okay. Now, we'll discuss one more small chapter and then take a break. Accounting for ESOPs. It's a small chapter, but very important. Every exam, one question. It could be 5 marks or it could be 10 marks. Okay. Every exam, one question for sure. Now, in ESOPs, first we need to understand 3 terminologies. Vesting period. What is vesting period? The time limit that we have to wait to become eligible for the ESOP shares. Right? Eligibility, waiting period. Exercise period. What is exercise period? The time period given after the vesting period to subscribe for the shares, to exercise the shares. Correct? That is exercise period. And the last one, lock-in period. This is after allotment. You cannot sell the shares for so many years. That is lock-in period. Right? These are the 3: vesting period, exercise period, and lock-in period. In accounting for ESOP, whenever we are identifying the expenses, it would be based on which period? Vesting period, exercise period, or lock-in period?
Vesting.
Vesting period. It will always be based on vesting period. It shall always be based on vesting period. Now, what would be the expense that we have to recognize? Simple. In case of ESOP, let us say the market value is 30 rupees. We are allotting the shares to the employees at 20 rupees. That is 10 rupees lesser. Why are we allotting them at 10 rupees lesser? Because they are the employees of the company. Correct? So that 10 rupees represents employee compensation expense that have to be recognized by the company. Correct? Now, this 10 rupees per share, I cannot recognize in the first year itself because vesting period is 3 years. So going by the accrual principle, we have to apportion it over the 3 years. That is what the guidance note says. Correct? We have to apportion it over the 3 years. So for that, what should we do? Find out the total compensation expenses. How do we find out total compensation expense? For that, we need to find out something called intrinsic value or fair value. What is intrinsic value or fair value? Market value minus
Exercise.
Price. Market value minus exercise price gives us intrinsic value or fair value. That intrinsic value or fair value would be multiplied by
Number of options.
number of options. Yeah, number of options.
Granted.
Expected to vest. It's an expectation that we are making now itself. It's a judgment. Accounting estimate. Am I audible?
Yes, sir.
Yes, sir.
Estimate that we are making. So number of options expected to vest into intrinsic value or fair value gives us total expenses divided by the number of years, number of vesting years. That gives us amount to be recognized per annum. Correct? Amount to be recognized per annum. So that is the principle. Yes, there are some adjustments that we might encounter. Like the number of options might change, right? It can get lapsed. Some of the options get lapsed in the second year. In that case, we have to revise our estimate and accordingly calculate. Correct? That is what we would have learned. Now, what would be the entries that we have to pass? First year, when we are recognizing the expenses, employee compensation expenses account debit to
ESOP out.
very good. ESOP outstanding account. When are we doing this? When vesting period is more than 1 year. In some questions, 5 marks, direct question can be asked, wherein vesting period in the sense ESOP is granted in that year, it gets vest, it gets exercised, it gets allotted in the same year. In that case, should we open ESOP outstanding account?
No, sir.
We need not open ESOP outstanding account. Correct?
No.
Yeah. So we need not open ESOP outstanding account. In that case, directly employee compensation expense account debit to
P&L
P&L
account.
account.
P&L account. P&L account would be credited for recognizing the expense.
Share capital accounts.
Yes. Employee compensation expense account debit to equity share capital account. Or bank account is also there because we would receive money. Employee compensation expense account debit, bank account debit to equity share capital account to securities premium. Now what happens to that employee compensation expense? It would be transferred to P&L account debit to employee compensation expense. Is that clear? That is when in the first year itself it gets vested, exercised and allotted. But if it is not vesting period is more than 1 year, then we create a temporary account called ESOP outstanding account. So first year employee compensation expense account debit to ESOP outstanding account. What happens to employee compensation expense? Transfer to P&L. P&L account debit to employee compensation expense. That is what we do. Correct? Then second year also same entry. Amount might change. Third year also same entry. When the shares gets vested, and it gets exercised, then what would be the entry that we have to pass? Bank account debit. Now, what would be the other debit?
ESOP
Very good. What amount lying in ESOP outstanding account would be brought in? ESOP outstanding account debit to equity share capital to securities premium. Now, initially there could be 1,000 shares that were granted. But at the end of the day, there could be only 900 shares that gets exercised. So because of that balance 100, we would have already recognized the expense. ESOP outstanding account will still have the balance. We have to close it. How do we close it?
General reserve.
Transferring it to general reserve. ESOP outstanding account debit to general reserve account. Is that clear?
Yes.
Yes. This is the basics of ESOP that we have to keep in mind. Can we write down? Accounting for ESOPs. Accounting for ESOPs. Below that, for recognizing the expenses, always consider vesting period. Always consider vesting period. For recognizing the expenses, always consider the vesting period. Below that, employee compensation expenses is equal to number of options expected to vest, into intrinsic value or fair value. Into intrinsic value or fair value. Below that, intrinsic value or fair value is equal to 12 marks. intrinsic value of fair value is equal to 2 arrow marks, left hand side. Left hand side, if fair value is specified in the question, go with that fair value, consider that fair value. Consider that fair value. Right side, if fair value is not mentioned, then market value minus exercise price. Market value minus exercise price. Correct? Yes. Below that, this employee compensation expenses.
Totally below that?
Completely below that, yes. Completely below that. This employee compensation expenses shall be recognized over the vesting period. Shall be recognized over the vesting period. Okay. Again, completely below, journal entries to be passed. Journal entries to be passed. First one, Roman number 1, if vesting period is within 1 year. Vesting period is within 1 year, within brackets. Shares are allotted in the same year. Shares are allotted in the same year. Below that, entry number 1, employee compensation expense account debit. Employee compensation expense account debit. Bank account debit. Bank account debit. To equity share capital account. Equity share capital account. To securities premium account. Securities premium account. Done? Yes. Second entry. Second entry, profit and loss account debit to employee compensation expense account. Profit and loss account debit to employee compensation expense account. Next, Roman number 2. Roman number 2, if vesting period is more than 1 year. If vesting period is more than 1 year, below that, every year, to recognize the expenses, first entry number 1, employee compensation expenses account debit. Employee compensation expense account debit to ESOP outstanding account. Employee compensation expense account debit to ESOP outstanding account. Entry number 2, P&L account debit to employee compensation expense account. After that, below that, each year, there might be change in the options vested, options expected to vest. Each year, there might be change in the options expected to vest as some of the options can lapse. As some of the options can lapse. Each year, there might be change in the number of options expected to vest as there can be
Some of the options can be lapsed.
as some of the options can lapse. Yes, as some of the options can lapse. Full stop. Accordingly, the expense to be recognized should be changed. Accordingly, the expense to be recognized shall be changed. Below that, Roman number 3. Roman number 3, at the end of the vesting period. At the end of the vesting period, at the end of the vesting period, 2 arrow marks. 2 arrow marks, left hand side. To the extent the options are exercised. To the extent the options are exercised, bank account debit, ESOP outstanding account debit to equity share capital account to securities premium account. Bank account debit, ESOP outstanding account debit to equity share capital account to securities premium account. Right side, to the extent of the options lapsed. To the extent of the options lapsed, ESOP outstanding account debit to general reserve account. ESOP outstanding account debit to general reserve account. Done?
Yes, sir.
Yes, that's all. These are the journal entries that we have to keep in mind. Right? Sometimes it can be graded vesting, or it could be based on some conditions, right? Wherein the options gets vested if the average earnings of first 2 years is so and so, first 3 years is so and so. So in that case, when you are recognizing the expense at the end of 1 year, check whether the condition is satisfied. If the condition is not satisfied, we will consider the vesting period as
2 years.
2 years. Very good. We'll consider the number of vesting period as 2 years. Then again, at the end of 2 years, we will check the condition. If the condition is not satisfied, then we'll consider the vesting period as
3 years.
3 years and accordingly revise the calculation. Correct? Revise the calculations. Yes. So that's it. This is ESOP. We'll quickly look into the problems. We'll go to November 22 exam. It was also 5 marks. Yeah. At the beginning of year 1, an enterprise grants 1,000 stock options to a senior executive, conditional upon the executive remaining in employment of the enterprise until the end of year 3. The exercise price is ₹400. However, exercise price drops to ₹300 if the earnings of the enterprise increase by at least an average of 10% per year over the 3-year period. On the grant date, enterprise estimates that the fair value of the stock option with an exercise price of 300 is rupees 160 per option. If the exercise price is 400, enterprise estimates that the stock option have a fair value of rupees 120 per option. During year one, earnings of the enterprise increased by 12%, and the enterprise expects that the earnings will continue to increase at this rate over the next 2 years. The enterprise therefore expects that the earnings target will be achieved, and hence stock options will be recognized will have an exercise price of 300. During the year two, enterprise earnings of the enterprise increased by 13%, and the enterprise continues to expect that the earnings target will be achieved. During year three, earnings of the enterprise increased by only 3%, and therefore earnings target was not achieved. Executive completes 3 years service and therefore satisfies the service condition. Because the earnings target was not achieved, 1000 vested stock options have an exercise price of rupees 400. You are required to calculate the amount to be charged to P&L account every year on account of compensation expenses. So, at the end of year one, when you're calculating the total expense, will you consider the exercise price as 300 or 400?
300.
300, because at the end of year one, the sales target achieved, the earnings achieved was 12%. Therefore, they presumed, they expected that same rate would be maintained. So exercise price would be 300. So can I say the total expense to be recognized would be 1000 into 300 divided by 3, because 3 years? The answer is no, because 300 is the exercise price, not the fair value. At the 300 exercise price, 160 rupees is the fair value. So 160 rupees into 1000, fair value into number of options expected to vest. 1000 into 160 would be the total expenses, divided by 3 would be the expense recognized at the end of year one. 1000 into 160 divided by 3. Clear?
Yes.
Yes. Then at the end of year two also, it's the same, because they had achieved 13%, I think. Yeah, 13%. So again, same divided by 3. Whatever they have recognized at the end of year one, same expenses. But at the end of year 3, only 3%. So they did not achieve the target. So exercise price increased to 400. At 400, fair value is only 120. So 120 into 1000, you'll get, I think, 1,20,000, correct? 1,20,000. But we have already recognized how much? 1,60,000 into 2 by 3.
Yes.
So balance amount would be recognized in this year, the last year. That is how expenses would be recognized. Is that clear?
Yes.
Simple.
Yes.
You have just to calculate the amount, no journal entries as well. Okay, just a calculation, a table. Same way, May 23, RTP. May 23 RTP, page number 7. Yeah. A Limited grants 5,000 options to its employees on 1/4/2018 at rupees 90, when the market price was 150. Vesting period is 3 years. Maximum exercise period is 1 year. 4,500 options were exercised on 31/3/2022. Remaining options lapsed. Journalize the transaction if the face value of the equity shares is 10 rupees. Simple question, no adjustment at all. Right? What is the intrinsic value?
60.
Very good. What is the total number of options? 5,000. So 5,000 into 60 will give me the total expense divided by 3. Same entries for 3 years. At the end, only 4,500 options got exercised. Balance 500 options related amount would be transferred to
Central Reserve.
reserve account. Will be transferred to general reserve account. Is that clear?
Yes.
Yes, sir.
Yes, sir.
This was simple. We'll look into one more question. This is again simple. Same year, everything has happened. I'll go to the next. Okay, this question itself is. See, if you look into this question, Mehta Limited grants 1,500 stock options to its employees on 1/4/2019 at rupees 50. Vesting period is 2.5 years. Maximum excess period is 1 year. Market price on that date is 80. Fair value per option is 30. All options are exercised on 30th 9 journal entries. Again, simple, but in the first year, should I recognize 0.5 or full years?
Full year.
Full.
Full year because it was in April, correct? So third year, we will have 0.5. So 18, 18, 18, third year, it was 9. Okay, apart from that, nothing is there here, simple. Then July 21 RTP, July 21 examination question. At the beginning of year 1, Harmony Limited grants 600 options to each of its 1000 employees. Contractual life of the option granted is 6 years. Other relevant information. Vesting period is given, exercise period is given, expected life is given, exercise price is given, market price is given, expected for features per year is given. Option granted vest according to graded schedule. 25% at the end of 1 year, 25% at the end of year 2, remaining 50% at the end of year 3. You are required to calculate total compensation expense for the options expected to vest and the cost and cumulative cost to be recognized at the end of all 3 years, assuming that the expected for feature rate does not change during the vesting period when the intrinsic value is 7 rupees per option. So we have to just calculate the expenses. The point is, we have 3 different ESOPs. First ESOP, 25% exercising in the vesting at the end of year 1. Second ESOP, 25% vesting at the end of year 2. Third ESOP, vesting at the end of 50% vesting at the end of year 3. Correct. Now, first you will calculate the total expenses. You will calculate the total expenses. Then total options, rather 600 options into 1000 employees. What is the total?
6 lakh.
Lakh.
Like.
Options. Out of 6 lakh options, 1,50,000 options vest at the end of year 1.
Yes.
So 3% for feature rate. What at the end of year 1, 1,50,000 into 3% is 4,500. So can I say 1,45,500 is the options that will vest? Since at the end of year 1, full expense will be recognized at the end of year 1 itself. End of year 2, 25% again. So 1,50,000 options. First year 4,500 got lapsed. You got 145,500. Again, second year 3% lapse.
Yes.
4,365. This gives us the number of options gets exercised. So at the end of year 1, you will recognize. At the end of year 2, you will recognize the expense 50-50 divided by 2. Same way at the end of year 3, you will recognize the number of options based on giving a reference to the vesting. Here they have told 7 rupees is a fair value. So we have to just calculate the expenses to be recognized. So at the end of year 1, first one, 145,500 that we got. Second one, 141, 135. Third one, 273, 802. Number of options to be vested. Now, first year 145,500 into 7. 145, 135 into 7, 273, 802 into 7. That gives us the total expenses. But this is total expenses. But if you want year-wise, so first 10,000, 10 lakh 18,000. In which year you will recognize that? First year itself. Correct? 987. Which year you have to recognize? 1 and 2 equally divided by 2. 1 and 2 equally. This how will you recognize? 1, 2, 3 equally divided by 3. 1, 2, 3 equally. So total expense at the end of year 1, total expense at the end of year 2, total expense at the end of year 3. Okay. This is accounting for ESOPs. Any doubts in this? No? Yes, follow the basic structure that is given. There could be some adjustments that can be asked. There could be some adjustments that can be confusing. Those adjustments have been discussed in the class. So those in our notes, those special adjustments that are there, just look into those adjustments. You should be easily attempting this question. Whether it is for 5 marks or 10 marks, we should easily get this. Is that clear?
Yes, sir.
Yes, sir.
Yes, sir.
With this, we are done with 3 chapters, around 30 marks in the paper. Okay, now we'll move on to the next chapter. Before that, we'll take a break. Is that fine?
Yes.
Yes, sir.
Yes. Okay, take a break. We'll come back at how much minutes break you want?
Your wish,
15
sir.
minutes, sir, so that we can have dinner.
15. Anyhow, you'll be having dinner during the revision classes itself. Right?
10 minutes.
10.
We can't write.
10 minutes. 10 minutes. Come back at 9:10. We have 3 more chapters to be discussed.
Thank you, sir.
Yes.
Yes, sir. Thank you.
Yes, friends, are we back? Everyone had your dinners?
Yes, sir.
Yes, sir.
Yes, quick and fast. Shall we proceed?
Yes.
Yes. Okay. Fine. So we had completed 3 chapters. The 4th chapter, we'll start with the 4th one. Easy chapter, buyback of securities. Now, with regard to buyback of securities, what is buyback? The company itself will buy back the shares from the shareholders. For that, company has to pay money. Correct? Company has to pay money. Now, buyback can, since buyback involves flow of money, right? For that, buyback can happen through 2 modes. What are the 2 modes? First one, free reserves. Correct. Free reserves on securities premium by creating
DR.
TRR. Second one by
Proceeds of
fresh issue of shares, right? By fresh issue of shares. So it can be either of the 2, or it could be combination of both, right? Then in case of buyback, there are certain conditions to be satisfied. We call them tests. 3 tests that we have. First one, equity test. What does equity test talk about?
25% of paid up capital plus free reserve.
25% of paid up capital plus free reserve is the maximum permissible buyback. Correct? 25% of PUC plus FR. Next, shares outstanding test.
25% of paid up equity shares.
25% of number of shares outstanding. Okay. So in case of resource test or equity test, resource test, it is what? 25% of PUC plus FR, resource, the total amount available. When in case of shares outstanding test, we are looking on number of shares. 25% of number of shares. Then the last one, debt equity ratio test, or debt is to PUC plus FR ratio test. So it says debt is to PUC plus FR after buyback cannot exceed
2:1.
2:1. Everyone.
Yes.
Yes, these are the tests compulsorily to be satisfied. In some of the questions, they say the tests are satisfied, you have to just pass the entries. In some of the cases, they can ask you to calculate, or they can ask you to check. Correct?
Yes.
Yes. Now, once these are done, you have to pass journal entries, right? So passing journal entries are simple. But during the course, if they're asking the number of shares to be bought back, what is the maximum permissible number of shares to be bought back, then you're checking all the 3 tests, whichever is whichever is the lowest, that would be the number of shares that you can buy back. In that, PUC plus FR, the shares outstanding test is easy. Number of shares into 25%. When you are calculating PUC plus FR ratio, what is the issue here? 25% of PUC plus FR, existing PUC plus FR into 25%, we cannot do directly. Why? Why? Because we have to consider X and Y. Correct? Now, here, when we have 100 lakh as PUC plus FR together, if I buy back, what happens? Buyback normally will be at premium. Correct? 10 rupee face value. Let us say we are buying back at 20 rupees. Then I have to create CRR to the extent of how much?
10 rupees.
10 rupee per share. Right? I have to create CRR to the extent of 10 rupee per share. And when I'm buying back, my share capital and reserves get reduced because of this 20 rupees. Share capital of 10 rupees, securities premium of 10 rupees gets reduced. So technically, there will be 2 reductions in PUC plus FR. One is the amount of buyback. Second is the CRR to be created. The amount of buyback is considered as X. CRR to be created is considered as Y. Then an equation is created. Based on that, we will find out the maximum possible buyback. Correct? Everyone getting it? Remembering what we have discussed?
Yes, sir.
Yes. So based on that, we have to calculate when we have PUC plus FR ratio, that is resource test. Whereas debt equity ratio test, debt is to PUC plus FR is simple. We know the debt. What is the PUC plus FR remaining? We can calculate. So based on that, we can again substitute, have an equation and calculate the maximum possible buyback permissible. Is that clear?
Yes.
That is, these concepts are to be applied only if number of shares to be calculated. If number of shares are already given, just simple pass journal entries. What are the journal entries to be passed? First, due entry. What is the due entry? Equity share capital account debit.
Premium paid
on buyback.
Debit to
Equity share payment.
equity share buyback account. Then we will create CRR reserves debited. Concerned reserve account debit to CRR account. Third,
Right of premium.
write off of premium. How do we write off premium?
Securities.
Premium account
Free
to
reserve.
premium pay.
Premium payable on buyback. If security premium not available, go with free reserves. Then the last one, payment. Equity share buyback account debit to bank account. Correct? These are the 4 entries to be passed. That's all. This is what is there in this chapter. Any doubts in this?
No.
Am I audible?
Yes, sir.
Yes, sir.
Yes.
Okay, write down. Buyback of securities. Buyback of securities. Below that, buyback can be out of two arrow marks. Left hand side, free reserves and securities premium. Free reserves and securities premium by creating CRR. Buyback and securities premium by creating CRR. Right hand side, fresh issue of shares. Fresh issue of shares. Now, when we are issuing shares, it could be equity or preference. Correct? It can be equity or preference. Below that, completely below that, 3 tests to be satisfied. 3 tests to be satisfied. Under that, three arrow marks. First one, shares outstanding test. Shares outstanding test. 25% of the number of shares outstanding. 25% of the number of shares outstanding. Second one, resource test. Second one, resource test. 25% of
Total paid up charge.
PUC plus FR. 25% of PUC plus FR. Third arrow mark, debt equity ratio test. Debt equity ratio test. Below that, debt is to PUC plus FR cannot exceed
2:2.
2:1. Debt is to PUC plus FR cannot exceed 2:1. Completely below that. Completely below that. When we are calculating debt is to PUC plus FR ratio, debt is to PUC plus FR ratio, since this shall be calculated
So your video is
Can you repeat that last line?
When we are calculating debt is to PUC plus FR ratio, since
audible
this
now?
shall be. Yes, sir.
Yes. Okay, fine. There is huge technical issue today. Okay, no problem. Now, what were we writing? When there is
When calculating debt.
when calculating debt is to PUC plus FR ratio, when the calculating debt is to PUC plus FR ratio, since this has to be calculated post buyback, consider the reduction of the amount of buyback, as well as
Reducing.
CRR to be created, in the revised PUC plus FR. Full stop. Here, amount of buyback will be considered as X. Free reserve to be CRR to be created is considered as Y. CRR to be created is considered as Y. Next, completely below that, entries to be passed. First one, equity share capital account debit. Premium payable on buyback account debit. To equity share buyback account. Equity share capital account debit, premium payable on buyback account debit, equity share buyback account. Entry number 2, concerned free reserves account debit to capital redemption reserve. Concerned free reserve account debit to capital redemption reserve. Third, securities premium account or free reserves if securities premium is not available. Securities premium account or free reserves account debit to premium payable on buyback account. Last one, equity share buyback account debit to bank account. Done. Yes, Ritvik.
Yes, sir. So for this debt is to PUC plus FR ratio. In case the company is going for fresh issue of shares, will that
Right.
PUC be included for it?
Yes, obviously. See, if it is fresh issue of shares, see, basically what we have to do, we are going with debt is to PUC plus FR after buyback. Correct. So when we are going with the debt is to PUC plus FR after buyback, what should we do? We have to consider PUC after buyback, FR after buyback. Yes, that
Yes,
includes issues, right? Yes. Okay. Right. So this is about buyback. Can we look into some of the questions?
yes.
Yes. Again, first we'll go to the question paper, last exam. 5 marks. It was asked for 5 marks. Where is the question? I think it's here. Yeah. PG Limited furnishes the following balance sheet as at 31st March 2022. Equities and liabilities, shareholders fund, share capital, reserves and surplus, current liabilities, trade payables, other current liabilities, assets, non-current assets, property, plant and equipment, non-current investments, current assets, inventory, trade receivables, cash and cash equivalents. That is what they have given. Notes to accounts have given equity share capital, reserves and surplus, securities premium, general reserve, CRR and P&L account. On 1st of April 2022, company announced buyback of 25% of its equity shares at rupees 15 per share. For this purpose, it sold all of its investments for 750 lakhs. On 5th of April 2022, company achieved the target of buyback. You are required to pass necessary journal entries for the above transaction. So we have to just pass journal entries. Easy. 4 journal entries that we have to pass. Simple. This was also 5 marks. Okay. Next, RTP. Again, a simple question. Pay Limited provides you with the following information as at 31st of March 2022. They have given us authorized capital and issued capital, equity, reserves and surplus, capital reserves, securities premium, revenue reserve, P&L account, current liabilities and provisions, fixed asset cost minus accumulated depreciation, non-current investment at cost and current assets. Company redeemed preference shares at a premium of 4% on 1st of April 2022. It also bought back 2.5 lakh equity shares of ₹10 each at 40 per share. The payments for the above were made out of bank balances which appeared as part of current assets. That means they are utilizing or they are creating what? What does this indicate?
Using free reserve.
They are creating CRR using free reserves. Very good. Correct. So they are not issuing fresh shares because they have sufficient bank balance. They are paying through the bank balance. So here they are asking us the journal entries to be passed. 2. One is preference shares redemption. Second one is buyback. Right? That is why we say go with both the groups. We have to go with group 1 here. If you have forgotten that, go with that. Next, prepare balance sheet as on 1st of April 2022. Same after redemption and buyback. We have to prepare the balance sheet. Easy. Okay, we'll not go in detail because nothing, it's the same thing that we have already discussed. So this is how it can be asked. If you want, I can look into one more question. The previous RTP. Umesh Limited resolves to buy back 4 lakh of its fully paid up equity shares of ₹10 each at 22 rupees per share. This buyback is in compliance with the provisions of Companies Act and does not exceed 25% of the company's paid up capital. For the purpose, it issued 1,11% preference shares of ₹10 each at par. Now, can we issue preference shares for buyback of equity shares?
Yes, sir.
Yes, because when we say fresh issue, it could be equity or preference. Correct? Yeah. So the entire amount being payable with application, company uses 16 lakh of its balance in securities premium apart from its adequate balance in general reserve to fulfill the legal requirements, journal entries. So here, fresh issue is also there, preference shares issue, and then buyback of shares. We have to see whether CRR has to be created or not, because 11% preference shares, 1 lakh. So 1 lakh into 10 rupees is 10 lakh. They are buying back 4 lakh equity shares of ₹10 each, 40 lakh. So there is a need to create CRR. Balance should be CRR. That's all. This is buyback of shares. Okay. Now, can I, in this part, as a part of this chapter, I think we have one more small discussion, an easy discussion. Equity shares with differential rates. Now, there are 2 types of capital, equity capital, preference share capital. Preference shares, full stop, no further discussion. Equity share capital with voting rights, with the differential rates. The differential rates can be with regard to dividend, voting, or otherwise. Correct? Now, that is not our concern. Now, when does preference shareholders get voting rights? In certain specific cases, when their rates are affected, when there is a resolution for winding up, when there is a reduction in capital, or if dividend is not paid for 2 continuous years, all resolutions. Correct? These are the cases where preference shareholders get voting rights. Now, what is the issue here? When preference shareholders get voting rights, how do we determine whether special resolution is passed or ordinary resolution is passed? Based on proportional basis. Correct. We would calculate the proportional weightage of votes of equity shareholders and preference shareholders. How? Based on total paid up capital. So if equity share capital is 100 lakh, preference share capital is 50 lakh, two-third weights to equity shareholders, one-third weights to preference shareholders, depending upon the paid up capital. Correct. Yes.
Yes.
So simple questions can be asked in the exam. It was, if I'm not wrong, yeah, no question was asked in the previous exam. So there's a high chance of one question being asked in the coming exams. Okay. So it's very easy. 5 marks, easily we can score. 5 marks of buyback, 5 marks of equity shares with differential rates. Easily we can take those 10 marks. How would the questions be? We'll look into the RTP. Before that, write down a couple of points in this. Equity shares with differential rates. Equity shares with differential rates. Below that, types of capital. Types of share capital. 2 arrow marks, equity preference. Types of share capital, 2 arrow marks, equity preference. Under equity, 2 arrow marks with voting rights. And with differential rights as to dividend, voting, or otherwise. With the differential rights as to dividend, voting, or otherwise. Below that, preference shareholders are given voting rights in the following cases. Preference shareholders are given voting rights in the following cases. First one, when their rights are directly affected. This can be asked as a theory question also for 5 marks. When the rights are affected. Second one, resolution of winding up of the company. Resolution for winding up of the company. Third one, for reduction or repayment of equity or preference share capital. For reduction or repayment of equity or preference share capital. Next, if dividend is not paid for 2 years, 2 continuous years, when dividend is not paid for 2 continuous years, then vote for all resolutions. Vote for all resolutions. Below that, when preference shareholders are also allowed to vote, when preference shareholders are also allowed to vote, then proportionate voting rights of equity and preference shares, proportionate voting rights of equity and preference shares shall be calculated. Proportionate voting rights, Rashmi, proportionate voting rights of equity and preference shares shall be calculated. Done. Completed. How to calculate proportional voting rights? Based on paid up capital. So, shall be calculated based on paid up capital. Next. Example. Equity paid up capital 100 lakh. Preference paid up capital 50 lakh. Equity paid up capital 100 lakh, preference paid up capital 50 lakh. Then weightage to equity shareholders 2/3 and preference shareholders 1/3. Done? Yes. Okay, we'll look into some of the questions. First, I'll look into RTP. Okay, so here we have a theory question. Explain the meaning of equity shares with differential rights. Also explain the conditions under Rule 4 to deal with equity shares with differential rights. Okay, there are some conditions that we have discussed during the classes. Okay, so if you want, I can share this. Yeah. Equity shares with differential rights means share with dissimilar rights as to dividend, voting, or otherwise. In exercise of power conferred, there is a rules that is prescribed, rules laid on the conditions. Articles of association should authorize the issue of shares. Issue of shares is authorized by ordinary resolution is passed. Right? Then voting power in respect of shares of differential rights shall not exceed 74% of the total voting power. Company should not have defaulted in filing financial statements, annual returns. If there is subsisting default in payment of dividend, deposits, debentures, etc., not possible. Default has not defaulted in payment of dividend on preference shares or repayment of any term loan, repayment of term loan also, or at any amount transferred to IEPF account, or it has not been penalized by any of these codes under any of these laws. These are the conditions. Now coming to theory, how to focus on theory questions. No need to spend additional time for those theory questions. What you have to do is just look into RTP questions, suggested answers, previous few questions, MTP questions. Focus on those things for theory, other chapters. Accounting standard, obviously, concept-based, some theory can be asked. Whereas other theory questions, only focus on this, because you will get those theory questions most of the time only in question number 6. Right? 2 to 3 questions of theory, not much more than that. So do not spend much time on theories. Only focus on these specific questions that we have. That's all. That would be more than sufficient. Okay, one more question. Yes, Ritvik.
Sir, when preference shareholders are given voting rights,
Yeah.
you have said when dividend is not paid for 2 consecutive years.
Right.
Does that mean it's declared and not paid?
No. See, normally in case of preference shareholders, dividend have to be paid. It comes with the coupon rate. Right? Even if it is not paid, it's not declared as also, preference shareholders will be given the rate. Right to vote.
Yes, sir.
Okay, so November 22 RTP. This is fine. Equity shares with differential rights. Now, can preference shares be also issued with the differential rights?
No.
No, in preference shares, no such concept. Yes. LMA no hold equity by capital in 30-30-2020 in AB Limited. XYZ and K hold preference shares in 40-30-2010. You are required to identify the voting rights of the shareholders in case resolution for winding up of the company. If paid up capital of the company is 80 lakh and preference shares, equity is 80 lakh, preference shares is 40 lakh. So 2:1. Same. 2/3 and 1/3. Easy.
Yes.
Okay, fine. So with that, we are done with buyback and equity shares with differential rights. Okay. Next chapter, liquidation of companies. It is a lengthy chapter, but from examination point of view, 5 marks. Very rarely 10-mark question has been asked. Okay, what all we have to focus? We need not waste time here. There are some of the points that we have to focus there. What can be asked in the examination? Most of the times they focus on liquidator's final statement of account. Correct? It's a receipt and payment account that we prepare. The only focus here is order of priority of payment. While making the payment, we have to focus on the order of priority. That's the only thing that we have to focus. Second, very rarely they ask statement of affairs, but we have to remember the lists. List A, B, C, D, E, F, G, H. What are those lists we have to remember? And certain specific points like calls in arrears, calls in advances, and how do we calculate the amount to be refunded to the shareholders? Those specific points that we have to focus on. Okay. In statement of affairs, as I just discussed, we have 8 lists, correct? List A and B talks about asset. A is asset which is not pledged. B is asset is pledged. Since asset is pledged, we have to give the details of such secured creditors as well in that list itself. From list C, we have liabilities. List C is preferential creditor. List D is debenture holders with floating charge. List E is unsecured creditors, done with liabilities. F and G talks about shareholders. F is preference shareholders, G is equity shareholders. H is deficiency or surplus. Correct. Now, this statement of affairs will include calls in arrears, but it will not include uncalled capital. If it's partly paid up, that uncalled capital will not be included. Next, we prepare liquidator's final statement of account. Here we have, it's a receipt and payment account, simple receipt and payment account, but we have to focus on priority of payment. Receipt side, what would be there? Asset realized. Payment side, what would be there? Payment towards liabilities. But in payment towards liabilities, first we would pay secured creditors. Then we would pay legal charges, liquidation expenses, liquidators remuneration. Correct? Once these are done, we would come to what? Overriding preferential creditors, then debenture holders with
Floating.
floating charge. Very good. And then we have other unsecured creditors, the balance, unsecured creditors. Then if we have funds, pay preference shareholders, equity shareholders. That is the order of priority of payment. Correct? Now, when we are paying the debenture holders, we have to pay interest also. Till what date we have to pay the interest? Payment of interest depends upon the solvency status of the company. If the company is solvent, you have to pay till the date of payment. If the company is insolvent, you have to pay till the date of
Duration.
Winding up.
winding up. Very good. Till the date of winding up. Then we have something called contributories, A list contributory, B list contributories. Who are A list contributories?
Present employees.
Present existing equity shareholders, correct? Whereas B list contributories are those equity shareholders, the past equity shareholders who have transferred within 1 year, in the last 1 year from the date of winding up, and the shares are partly paid up. B list contributories can be called up only if A list contributories have failed to pay, correct? And what is the amount that you can call up is the amount which is yet to be paid, partly paid up, the uncalled capital, or the share of liability as on the date of transfer. Share of his liability as on the date of transfer, whichever is
Low.
whichever is
Yes.
less. Correct. Share of his liabilities as on the date of transfer, whichever is lesser. Then what we have? What is the difference between overriding preferential creditor and preferential creditor? Section 326 and 327. 326 talks about overriding preferential creditors. Who are included there? Workmen. 4 payments to workmen are included in overriding preferential creditor. Whereas in preferential creditor, same 4 payments, but not to workmen, to employees. Same 4 payments to employees, but includes additional items, taxes, ESI payment, investigation expenses. Correct? In case of overriding preferential creditors, there is no monetary ceiling. But in preferential creditors, there is monetary ceiling. Salary to employee, 20,000 rupees maximum limit. And in case of taxes, you have a limit on number of years. Correct? So there are monetary ceilings. And is there a time limit? Overriding preferential creditor, no time limit. Whereas in case of preferential creditors, there are time limits for taxes, salaries, and ESI. That's the difference between overriding preferential creditors and just preferential creditors. Is that clear?
Yes, sir.
Yes. Next one. Now, if calls in arrears and calls in advances are given, how do we do that? How do we take care of that in liquidator's final statement of account? We have to realize the calls in arrears and pay the calls in advance. But when you are paying the calls in advance, you have to pay it only after payment of preference shareholders. Only after you have paid preference shareholders. Correct? Everyone understanding?
Yes, sir.
Yes, sir.
Yes, sir.
Repeat. Guys,
Understanding. Yes, sir.
Yes, sir.
Fine. So that's all. This is what is there in this chapter, liquidation. These are the points that we have to focus. Okay. Clear? Any doubts in this? Okay, write down. Liquidation of companies. Liquidation of companies. Under that, statement of affairs. Statement of affairs. List A to list H. List A to list H. Under that important point, includes calls in arrears and not uncalled capital. Includes calls in arrears and not uncalled capital. Includes calls in arrears and not uncalled capital. Next, liquidator's final statement of account. Liquidator's final statement of account. It's a receipt and payments account. It's a receipt and payment account where assets realized are recorded on the receipt side. Asset realized are recorded on the receipt side, and payment to creditors are recorded on the payment side. Payment to creditors are recorded on the credit side. Full stop. However, order of priority of payment have to be considered. Order of priority of payment have to be considered. Below that, order of priority, first one, secured creditors. Secured creditors within brackets who have relinquished their security. Within brackets who have relinquished their security. I'll come to that later. Secured creditors who have relinquished their securities. Second one, legal charges if any. Legal charges if any. Third one, liquidation expenses. Liquidation expenses. Fourth one, liquidator's remuneration. Liquidator's remuneration. Fifth one, overriding preferential creditors. Overriding preferential creditors. Sixth one, preferential creditors. Preferential creditors. Seventh one, debenture holders with floating charge. Debenture holders with floating charge. Eighth one, unsecured creditors. Unsecured creditors. Ninth, preference shareholders. And 10th, equity shareholders. 10th, equity shareholders. Below that, secured creditors, heading secured creditors, 2 arrow marks. Realize the security. Realize the security. Under that 2 arrow marks, realized more transferred to liquidator. Realized more transferred to liquidator. Next, realized less. Realized less, what happens? What happens?
The realized part is considered as secured, but unrealized is
Deficit.
unsecured.
Very good. So the deficit shall be considered as unsecured. Deficit shall be considered as unsecured. Right side, completely right hand side. Relinquish the security. Relinquish the security. Under that, first priority of payment. First priority of payment. Understood?
Yes.
Below that, payment of debenture interest. Payment of debenture interest, 2 arrow marks. 2 arrow marks. If the company is solvent, till the date of payment. Till the date of payment. Right hand side, if the company is insolvent, till the date of winding up. Till the date of winding up. Below that, company is said to be solvent. Company is said to be solvent if they are able to pay
Both interest and
no. If they are able to pay unsecured creditors. Company is said to be solvent if they are able to pay unsecured creditors. Done?
Yes, sir.
Yes. Okay.
Yes, sir.
Next. Below that, contributories. Contributories. 2 arrow marks. A list contributory, B list contributory. A list contributories, B list contributories. Below A list, existing shareholders. Existing shareholders. Below B list, shareholders who have transferred. Yeah, correct. Shareholders who have transferred partly paid up shares. Shareholders who have transferred partly paid up shares 1 year prior to the date of winding up. 1 year prior to the date of winding up. One year prior to the date of winding up. Below that, below B list contributories itself, they can be called only if A list contributories doesn't pay. They can be called only if A list contributories doesn't pay. Below that, maximum amount is equal to 2 arrow marks. Unpaid amount or the amount of liability as on the date of transfer. Amount of liability as on the date of transfer, whichever is less. whichever is less. Clear? Clear till here?
Yes.
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 Okay. Fine then. So these are some of the points that we have to keep in mind. We'll look into some of the questions. November 22. It was also 5 marks. Yes. Easy question. Proud Limited is being wound up by the tribunal. All the assets of the company have been charged to the company's banker, to whom the company owes 10 crore. The company owes the following amounts to others. Due to workers, 2.5 crore. Tax payable to government, 60 lakh. Unsecured creditor, 1.2 crore. You are required to compute with reference to the provisions of Companies Act 2013. Amount each kind of creditors is likely to get if the amount realized by the official liquidator from secured asset and available for distribution among creditors is only 8 crore. Now, how do we get this? How do we calculate this? When amount is not sufficient to pay secured creditors, then secured creditors and overriding preferential creditors would be given equal priority. Correct? That is what we have learned. Correct? So here secured creditors is 10 crore. Overriding preference. Out of this, which are overriding preference?
Dues to workers.
Used
Focus.
to
That's correct. So 12.5 crores is the amount that we have to pay them, but we have only 8 crores, I think. Yeah, 8 crores. So this 8 crores would be distributed among this, who is that banker, and workers in the ratio of 1:4. 1:4. Everyone understood? Yes, write down. Amount when the amounts available, are not sufficient, to pay the secured creditors and overriding preferential creditors, to pay the secured creditors and overriding preferential creditors in full, then it shall be paid among secured creditors and overriding preferential creditors. It shall be paid among secured creditors and overriding preferential creditors in proportion to their debts due. In proportion to their debts due. Example. Amount realized, amount available 8 crores. Amount available 8 crores. Secured creditors 10 crores. Secured creditors 10 crores. And overriding preferential creditors 2.5 crores.
Sir, could you please repeat the last part of it?
Secured creditors 10 crores. Overriding preferential creditors 2.5 crores.
Thank you, sir.
Below that, this 8 crores shall be paid as under. This 8 crores shall be paid as under. Secured creditors. Secured creditors 10 divided by 12.5 into 8. Everyone understanding what is 10 divided by 12.5 into 8?
Yes, sir.
Yes.
6.4.
6.43. Okay. Then overriding preferential. The balance. 2 divided by 12 or 2.5 divided by 12.5 into 8.
1.6.
1.6. So this is 6.4, 1.6. Okay. Clear? Yes. This was asked in November 22 for 5 marks. Easily we could have scored 5 marks here. May 23 RTP. We'll look into the question. BT Limited went into voluntary liquidation on 31st of March 22. It provides the following information on that data. Issued and subscribed capital, cumulative preference shares, equity shares of 75 paid up, equity shares of 60 paid up. Profit and loss debit balance, 12% debentures secured by floating charge, interest outstanding on debentures, creditors, land and building, plant and machinery, furniture, patent, stock, trade receivable, cash at bank. Preference dividend were arrears for 1 year. Creditors include preferential creditors of 75,000, balance creditors that discharge subject to 5% discount. Asset realized as under these are the assets realized. Expenses of liquidation amounted to 45,000. Liquidator is entitled to remuneration of 3% on all assets realized except cash at bank. All payments were made on 30th of June. You are required to prepare liquidator's final statement of account as on 30th of June 2022. Working what should for part of your answer. Now, in the liquidator statement of account, asset realization is not a problem for us. We have to just record as it is. Whatever is there, one extra is bank. As it is, we would take. Correct? The problem comes in the payment side. When we are making the payment, first priority is to secure creditors. Do we have any secure creditors here?
Debenture secured by floating charge.
That is debenture holders floating charge. Debenture holders floating charge will come under first priority? No. Correct? So can I say there are no secure creditors at all?
Yes, sir.
Okay. Next, do we have any legal expenses? I don't think so. Do we have liquidation expenses? Yes.
Yes,
so
sir.
expenses would be paid. Liquidator's remuneration. Easy. This realizations into 3%. Liquidator remuneration also would be paid. Then comes overriding preferential creditors. Do we have any overriding preferential creditors? They have given only preferential creditors. Correct. So there is no overriding preferential creditors. Directly preferential creditors of 75,000. Then what is the next step? Payment.
Debenture.
Very good, Sunil. Debenture holders floating charge. Now, should we pay interest also along with that? The answer is yes. Correct. Interest should be paid. 1,20,000. Now the point is, should we pay interest of 1,20,000 only, which is calculated as on 31st March 22, date of winding up, or should we pay interest up to the date of payment, 30th June?
Up to date of payment.
For that, we have to check whether they are solvent. Right? We'll see the answer. That will be easy for us. Question number 8. Question number 8. Asset realization is done. Liquidation expense, preferential creditor, liquidator's remuneration. This is wrong. Liquidator's remuneration first, then preferential creditors, then debenture holders. See, they have paid interest because they are able to pay unsecured creditors also. Since we are able to pay unsecured creditors also, company is solvent. Okay. Next, after debenture holders, then unsecured creditors. Now they have given us creditors. Out of that, 75,000 is preferential creditors. Balance is unsecured creditors. That 7,75,000, they are paid 5% discount, minus 5%. Unsecured creditors. Then we have preferential shareholders. Preferential shareholders 10 lakh. They have to also pay dividend of 1 year arrears. Can be paid. Then comes equity shareholders. With regard to equity shareholders, here if you see, one is 75 rupees paid up, one is 60 rupees paid up. Correct? In such cases, what should we do? We should calculate loss per share. If we remember, how do we calculate loss per share? Now, what is the total equity paid up? 19,50,000. Both. So 75 rupees paid up, 60 rupees paid up, add up. Balance available after payment to unsecured and preference shareholders, so available to equity shareholders is only 11,39,000. So 8,10,000 is the loss borne by the shareholders. There are in total 75 and 60 put together in total 30,000 shares. So per share it is 27.005. That means if they had contributed 100 rupees, 27.005 if I reduce, I have to pay how much? How much should I pay?
72.995.
72.995, correct? Wherein one class of the shareholders, they have paid 75 rupees. The other class is paid 60 rupees. So what should I do? For the 75 rupees, what should I do? Should I further ask them to pay?
No, sir.
No,
You
sir.
have to pay them back.
You have to pay them back. Because they have paid 75, but they should have paid only 72 rupees. Their share of loss is only 72 rupees, but they have paid 75. So we have to pay them back that 3 rupees or 2 rupees, 2.005 rupees. But the 60 rupees case, we have to recover the balance, 12 rupees. That is how we would calculate, correct? 27.005 is the loss per share. If 27.005 is the loss, I read it reverse. 27.005 is the loss per share, not 72 rupees. 27.005 is the loss per share, then they should have paid only 27.005. Correct? Is it confusing?
Yes, sir. No, sir.
No, I'll repeat again. See, what should we do? In case of calculating loss per share, calculate the actual paid up capital. Actual paid up capital. Here in this case, 7 lakh 15, 12 lakh. Not the total paid up, only the partly paid up. What is the actual partly paid up capital? Consider. Then what is the amount available after paying preference shareholders? What is the amount available? That can only be paid to equity shareholders. That gives me the amount that is the loss to be borne by the equity shareholders. Divide by the number of shares, irrespective of whether it is 60 paid up, 75 paid up, total the number of shares, divide. You will get loss per share. Now, this is the amount that have to be borne by every equity shareholder. In the first class, they have paid 75 rupees. Where only is 27 rupees, balance refund. In the second class, they have paid 60 rupees. They have to borrow only 27 rupees, balance refund. So that at the end of the day, every equity shareholder of each class, they'll bear only 27 rupees. Plus. Clear?
Yes.
Yes, sir.
Yes. Okay. So this is how it is asked in the RTP. Okay. Can we look into one more question?
Yes.
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 One more question. This is, I think, liquidator's final statement of account. That's fine. We'll go to 314 page number. Here we have a refund. One more. Yes. Different categories of shareholders of R2C Limited who went into liquidation on 1st April are as follows. 32,000 equity shares, 80 paid up, 48,035 paid up, 12,80,007 paid up. This is 10 rupees each. Be careful. You are required to distribute the surplus money among different categories of shareholders. Surplus available is 32 lakh. Same. Find out the total paid up capital. 32,000 into 80 rupees. You get 25 lakh 60,000. Correct?
Yes, sir.
48,000 into 35 rupees.
16 lakh 80,000.
16 lakh 80,000.
Right. And 12 lakh 80,000 into 7 rupees.
89 lakh 60,000.
18 lakh 8960. Total
1 crore 32 lakh.
1 crore 32 lakh. But we have only 32 lakh. Correct? So what is the loss total?
1 crore.
1 crore.
1 crore have to be borne by the shareholders. How many shares are there? 32,000, 48,000 and
1 lakh 28,000.
very good, because this is 10 rupee share. Since these are 100 rupees, either you convert this 100 into 10 or this 10 into 100. I am converting 10 into 100 easy because there are 200 rupees. Better convert this 10 into 100. If I convert this 10 into 100, what happens? 1 0 goes. 1,28,000 shares. So that gives us how many shares?
2,08,000.
2,08,000.
2 lakh 8,000.
8,000. Okay. 2,08,000. So divide by 2,08,000. What is the loss per share?
48.0708.
48.08. Everyone?
Yes, sir.
Yes. In this case, they have 80 paid up. So should we refund or ask more?
Refund.
Refund. 80 minus 48.08. Here they have paid 35 rupees. Ask or refund?
Ask.
Ask.
Ask. 48 minus 35, they have to contribute 13 rupees. Here they have paid 7 rupees. Ask or refund?
Refund.
Very good, refund, because this is 10 rupees. This is 10 rupees. So 48.08, they had converted 10 into 100. So technically for them, it is 4.808 loss. But they have paid 7 rupees. 7 minus 4.808 would be refunded. Understood?
Yes, sir.
Right? So go through such questions. This can be a little important in the exam. Okay, 5 marks, easy, but we have to know how to do it. That's all. Is that clear?
Yes, sir.
Yes, sir.
Yes. With that, we are done with liquidation as well. Now we have one more chapter left. Can I take for another half an hour?
Yes, sir.
Yes, sir.
Yes.
Yes.
Yes, sir.
Yes, sir.
Yes, sir.
Completed. NBFC, I have to discuss this because there are some amendments which have happened.
Yes, sir.
Okay, so we have to discuss this. That's the reason. Write down. This is a simple discussion, so we can directly start with writing down. NBFC. NBFC, below that, owned funds. Owned funds. Now, what are owned funds? First, focus on the share capital. In share capital, only paid up equity share capital will be considered. Does preference share capital be considered?
No. Compulsory.
Very good. So, write down paid up equity capital. Paid up equity capital plus CCPS, compulsory convertible preference shares. Compulsory convertible preference shares plus in reserves and surplus, free reserves definitely will be considered. So plus free reserves. Will securities premium be considered?
Yes.
Yes, sir.
Plus securities premium. Will capital reserve be considered?
Sale of
Which represents sale reserve. So capital reserve plus capital reserve representing surplus arising out of sale proceeds. Surplus arising out of sale proceeds. So these are the reserves that will be considered. From paid up capital, from share capital angle, equity capital will be considered, CCPS will be considered. From reserves angle, all free reserves, securities premium, capital reserve only if it is representing sale proceeds of assets would be considered. What would be specifically excluded? One.
deferred.
Correct. We'll go to the asset side, but there is on the liability side, there is one specifically excluded in the definition.
Evaluation.
Evaluation reserve.
Less revaluation reserve. That is, it should be excluded. If it is included in any of the above, it should be excluded. Excluding revaluation reserve. From that, we have to reduce accumulated losses, if any. So less accumulated losses. Less book value of intangible assets. Book value of intangible assets. And less deferred revenue expenditure. Deferred revenue expenditure. I'll repeat: owned funds, paid up capital, equity capital, CCPS, free reserves, securities premium, capital reserve representing sale proceeds of assets, excluding revaluation reserve, less accumulated losses, intangible asset, book value of intangible asset, and deferred revenue expenditure. Correct?
Yes.
Yes, sir.
This is own funds. Correct?
Yes.
Yeah. From that, we do not want own funds. For NBFC, what is required?
Net owned fund.
Net owned funds. Next line. Net owned funds is equal to. Net owned funds is equal to owned funds minus owned funds less investments in shares of subsidiaries or group companies Will investment in shares of other NBFCs also included?
No.
Yes, other NBFCs. Investment in shares of other NBFCs included. And book value of debentures, bonds, loans, etc. Debentures, bonds, outstanding loans, etc. made to subsidiaries or group companies. Here, NBFC is not there. So other NBFC is only here. Now, will we subtract the entire amount? The answer is no. To the extent it exceeds,
Exceeding 10%.
extent exceeding 10% of what?
Own funds.
Own. 10% of own funds. This gives us net own funds. Okay. Then, till this everyone understood calculation, important. They can ask in the exams. Net own funds calculation. Then we also, if you remember, we discussed NBFCs are divided into two categories: deposit accepting, non-deposit. Under non-deposit, systematically important, non-systematically important. In that, there is one amendment that has happened. Okay, I'll discuss about that at the end. Okay, as of now, they are trying to remove that deposit accepting, a non-deposit accepting, etc. They want 4 different categories. They want 4 different categories of NBFCs to be made. Anyhow, we'll discuss about that at the end. Now, income recognition. Normally, it is on accrual basis. Can be asked in the exam, theory question. Normally on accrual basis. However, on NPS,
Cash.
Only when
Cash basis.
cash receipt basis. However, if there is income already recognized upon classification as NPS, such income recognized which is not realized should also be reversed. Right? Then we also looked into income from investments, dividend, if it is an interim dividend, cash basis. If it is final dividend of body corporates, accrual basis, others, cash basis. That is what we have done. Bonds, etc. on accrual basis. Government securities, if it is guaranteed by state government or central government, then accrual basis, else cash basis. Correct? Then classification of assets. We have standard assets, substandard assets, doubtful assets, and loss assets. Correct? Write down classification of assets. Classification of assets. Under that, we have standard asset. Now, when do we consider it to be standard?
After 90 days from.
After 90 days.
Less than 90.
20 months less than.
So basically, there is no default. Standard, Apurva.
Yes,
Standard, no default. So what is the provision that we have to provide?
0.4%.
0.4%.
0.4%.
First.
0.25%. Very good. Then we have substandard asset. Substandard asset classified as NPA for
Up to 1 year.
1 year.
Yeah, classified as NPA for more than 1 year. Then it will be considered as substandard. Or there is one more case. When the loan is restructured, it will be immediately classified as substandard up to 1 year of satisfactory payment. One year of satisfactory payment. In case of substandard, what is the provision?
10%.
10%.
Outstanding.
Correct. Then you have doubtful assets. Classified as substandard for more than
1 year.
1 year.
1 year.
With regard to provisioning, they are classified into 2. Secured, unsecured. Correct? In case of secured, you have time limits. More than up to 1 year, more than 1 year, 1 to 3 years, to 1 year, more 1 to 3 years, then
More than
3 years.
up to 1 year, what is the provision?
25%.
10 plus 10, 20.
20%.
Then 1 to 3,
30.
30%.
30. Then more than 3,
50%.
20 plus 30, 50. Then unsecured,
100%.
last one, loss assets.
100.
Loss assets, that is identified as loss assets, correct? Identified as loss assets by NBFC itself. Yes.
RBI.
Internal auditors, external auditors, RBI. 100%. Clear? However, this provisioning is not applicable to one category of NBFC, which is that
Higher purchase.
very good, which deals with hire purchase and lease transactions, correct? For them, we have separate hire purchase and lease. First one, we have normal provisioning. How do we calculate the normal provisioning? We have to calculate total dues. Total dues means present receivable plus all future installments. Total dues. From that, what should we reduce?
Book value of
No, before that, this dues include
Unmatured
Finance charges.
the interest of future installments, which we have not yet recognized, correct? Unmatured finance charges. Everyone understanding?
yes, sir.
Yes, sir.
Yes, from that we will reduce,
Net book value.
correct, depreciated value of the asset. That gives you the provision to be created. What is depreciated value? How do you calculate? Original cost minus
Residual value.
original cost minus residual value.
Depreciation.
What is the rate of depreciation? I'm asking.
20%.
20%.
Excellent.
20% SLM. Yes, original cost minus 20% SLM. Next one, we have, apart from this, we also have additional provisioning. Additional provisioning comes into picture only in case of default. If it is overdue for
3 months.
up to 12 months, overdue for up to 12 months, what is the provisioning?
Then
Nil. Then 12 to 24 months,
10%.
10%. 24 to 36 months,
40%.
40%. 36 to 48 months,
70%.
70%. And lastly, more than 48 months,
100%.
100%. Now, when you say 10%, 40%, 70%, 100% of what?
Net book value.
Net book value. Yes, NBV. Net book value. How do you calculate this net book value? Same as normal provisioning. That is total dues minus unmatured finance charges. There you are reducing depreciated value. Here, instead of depreciated value, reduce the normal provision. Normal provision. That gives you net book value. That gives you net book value. Is that clear?
yes.
Yes.
Okay. Now, with regard to that NBFC, that amendment that I was talking about, I'll quickly summarize. Not so important, However, who knows, if they ask just a 5-marker simple question, right, we can easily answer. Now we had the existing classification as deposit to non-deposit. Under non-deposit, systematically important, non-systematically important. Now what they're doing is they're dividing NBFCs into 4 layers. What are those 4 layers? First one is a basic layer. So NBFC base layer. Second one is NBFC middle layer. Third one is NBFC upper layer. And the last one is NBFC top layer. Okay, if you have looked into the RTP, this is what they have given in the amendments regarding NBFCs. Okay, if you read, you might get confused, but ultimately this is what they have given. They have divided the classification into 4: base, middle, upper, and top. What are base layers NBFCs? NBFC, non-deposit accepting, non-systematically important, whatever we had, they are all base layers. They are all base layers. NBFC, non-deposit accepting, systematically important, plus NBFC deposit accepting. They are divided into middle layer and upper layer. What is the difference? If normally they are classified under middle layer. However, if RBI identifies them saying that they have a little extra risk than others, they can transfer them from middle layer to upper layer. Okay, so NBFC, NDSI, and NBFC deposit accepting would be in middle layer normally. However, NBFC is identified by RBI. NBFC is identified by RBI as requiring enhanced regulatory requirement. They'll give extra regulatory requirements as requiring enhanced regulatory requirement. Enhanced regulatory requirement, they will be classified. Apart from that, top 10 NBFCs in terms of asset size. Top 10 NBFCs in terms of asset size will automatically come under upper layer. Asset size, they will automatically come under upper layer. Okay, so normally these NBFCs would be in middle layer. However, if they require enhanced regulatory requirements, they can be transferred. However, top 10 NBFCs in terms of asset size automatically comes under upper layer. So if top 10 comes under upper layer, what comes under top layer? Answer is 0. As of now, nothing would be there. Normally, top layer would be empty. Normally, top layer would be empty. However, if upper layer NBFCs, how did we select upper layer? Requiring enhanced due diligence, enhanced regulatory requirement. If even after considering enhanced regulatory requirement, upper layer NBFCs require or have higher risk, then they will be transferred. Upper layer NBFCs, risk increases, then they can be shifted. Then they can be shifted. Is that clear? That's all.
Yes.
That is what we have to know in that amendment. We need not focus on other things. Okay, in that amendment, that is there. So 1 5-marker can be asked straight away. So you have to just write this. You'll get easily 5 mark if asked. I'm not sure whether they will ask or not. Okay, so now we will look into examination questions of NBFC. We had in November 22, there was one question asked. Everyone completed writing this?
Yes.
Yes, sir.
Yes, obviously at 10:30, everyone would have completed. Yes, November 22, we had one question for 5 marks. Look at this question. DS Finance Limited is a NBFC. It provides you with the following information regarding its outstanding amount, rupees 100 lakh of which installments are overdue on 400 accounts for last 1 month. Will it be considered as standard or substandard?
Standard.
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 And then the 1 month overdue is not even NPA, correct? 24 accounts for 2 months, standard or substandard?
Standard.
Standard.
10 accounts for more than 30 months.
Still standard.
Doubtful.
Still standard. Why?
Because it's not recognized as an NPA.
It would have been recognized as NPA. There is a rule, right? 90 days should
Yes.
be recognized. 3 months. So
They have given down.
they have given down information.
Out of
Yeah.
10 accounts overdue more than
Out of 10 accounts overdue for more than 30 months, 6 accounts are already identified as substandard for more than 12 months. That means those 6 accounts would be classified as
Substandard.
what?
Doubtful.
6 accounts are already identified as substandard for more than 12 months. If they have already identified as substandard for more than 12 months, why again substandard?
Doubtful.
Doubtful. And balance are identified as substandard for less than 12 months. That means they can
Substandard.
Substandard.
4 accounts for more than 3 years already identified as substandard.
Doubtful.
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 Since they are more than 3 years already identified as substandard, even though they have not given 12 months time there, we can consider it as doubtful. 1 account identified as not recoverable. This is
Loss asset.
Awesome.
so we have to just classify the assets classification. Right? It was asked for 5 marks. In the RTP of this examination, there is one question. Explain the income recognition criteria, what we discussed. Right? We have to just write that for 5 marks. Okay, we'll look into one more question. Lastly. Yeah. So here they're asking us calculation of own funds. Remember, this is not net own funds, it's just own funds. Paid up capital 200 lakh, will it be considered?
Yes.
Yes,
Yes.
150 lakh free reserves?
Yes.
Yes,
Yes.
sir.
Yes, 50 lakh.
Yes, sir. Yes.
350, 400 is done. Revaluation reserve 50 lakh.
No, sir.
Credit spending 45.
Yes, sir.
Yes, sir.
425 lakh. Book value of intangible at 10 lakh.
No.
No, sir.
It should be reduced. It's not no, it should be reduced. So 425 becomes 415. It should be reduced. Capital reserve surplus arising out of proceeds of assets.
Yes.
Yes.
Yeah.
Right? So that is how we have to do. So when we get revaluation reserve, we will not consider it because the definition says capital reserve excluding revaluation reserve. Whereas when we have book value of intangible assets or deferred revenue expenditure, accumulated losses, we have to compulsorily reduce it because the definition says less in those 3 cases. Understood?
Yes.
Yes, sir.
So they have given us the classification, sub question B. We have to provide provisions. We have to look into whether it is NBFC, small or big. It's not systematically important. So small NBFC, standard asset, what is the provision?
0.25.
0.25. Correct. That's it. That is how the provision would be. Next, last question. See, this is hire purchase. What we have to do? When they give overdue of 12, 24, 30, 45, we will calculate normal or additional?
Normal.
Normal. How do we calculate normal provision? When they give overdues? Then additional.
Addition.
When they give over, see, look at the provision requirement that we saw. In case of normal, what was required? Total dues minus unmatured finance charges minus depreciated value. No information is given here. When you look into additional requirement, they are talking about what? If the overdues are up to 12 months, 12 to 24, 24 to 36, 36 to 48, 48 and above, then it is 0, 10% of net book value that is given. 40% of net book value given. Correct? So, whenever they give amount overdue and net book value, it should be additional provisioning. It should be additional provisioning. We have to just apply up to 12 months. What is the amount of provision that you have to calculate? Percentage. Tell me the 24 months.
10%.
10%.
10%. 30 months.
40%.
40%.
5 months.
70.
90%.
That's
100.
correct. That's all. These are the questions that can be asked in NBFC. Okay. So with that, we have discussed all the 6 chapters. If we are thorough in these 6 chapters, 40 marks. 40 marks. Out of those 40 marks, definitely 30 marks can be easily achieved. Okay, if you get 30 marks in these 6 chapters, you have to just get 10 more marks to pass. Correct. So focus on this concepts fully. We have anyhow I've given notes also. So focus on that for concepts more than enough. Solve problems. You have to solve problems. Unless you solve problems, you cannot get these. And speed have to be improved. So focus on that as well. Both accounts and advanced accounting, speed has to be improved. Else it would be very, very difficult. Okay, even if you know the answers, you will not be in a position to complete it. Then that is very, very dangerous. Okay, so focus on speed, focus on the problems. So why I'm stressing on focus on problems is, yes, we know the concepts now, but when you're applying that concepts, you'll make silly mistakes. You will unnecessarily lose marks. Why? Because you would have not solved the problems. You have not practiced the problems. Only if you practice the problems, you will get that flow. If you get that flow in the examination, you will have the free flow of the answer. Definitely, the chances of mistakes would be very, very less. Okay, so for that, you have to solve problems and focus on the concepts that would help you. That's all. That is what is required in this subject. Okay, you have again 2 more days, right? No, 1 more day. Tomorrow and day after is the exam. Yeah, 1 more day. So focus on those. You should have already completed the most of those discussions of obviously Shetty sir's discussions. So preferably spend some time, even if some of the topics are pending there, it's okay. Spend some extra time tomorrow on these 6 chapters because it is fresh in your head now. It will require lesser time for you to complete it. So complete it and close it. You might require 6-7 hours to complete these 6 subjects. So 6 chapters. Okay. Any other doubts in this? No.
No, sir.
Okay. Right then. Thank you.
Thank you.
Thank you, sir.
Thank you, sir.
Night.
Thank you, sir.
Good night, sir.
Good night, sir. Bye, sir.
Thank you, sir. Have a great